Picture then across a number of assets. MSCI Asia Pacific up by 0.4%, getting that positivity coming through from Asia, but fairly muted, expecting to go a little higher here in Europe, but US futures flat and negative, we keep that in mind. To Tom's point, the dollar is a little bit stronger, which does tell you something interesting about where the market is a little nervous and what we're expecting perhaps from non-farm payrolls. Are we expecting the dollar to go higher, yields to go higher? What happens, as Mark says earlier on in the programme, if we get a weak print on non-farm payrolls? This is the US 10-year yield, checking in on where we are on that ahead of the jobs data, 4.73%, and the oil price down at 84.22. We've seen demand destruction back in focus in the oil markets, not so much supply constraint, Tom.
We look at these futures then. European futures, DAX futures pointing up by about 0.3%. Here in the UK, the FTSE 100 looking to add 24 points. Over in France, the CAC looking to add about 0.2%. Anna.
OK, so we're waiting for a bit of positivity in Europe as we wait for the non-farm payrolls. A lot of waiting today, waiting for US markets as well to open, and perhaps we'll see something flat to negative there. At least that's what futures suggest right now. So the FTSE 100 opening to the upside, up by 0.2%. The Spanish IBEX also up by 0.3%. This is the interesting move in the dollar this morning. The Bloomberg Dollar Index is a little bit stronger. Does that indicate, as I was mentioning, concern around higher rates? Or not the gains around higher rates, and this is the higher rate story. We are seeing the market return back to that theme. Is that our sort of reflex thinking as we wait for non-farm payrolls to come through? Different tenors in there as well, 2s, 5s, 10s, 30, a range of tenors then. Not actually seeing a great deal of movement this morning in commodities, but this week has really seen a reset of the story around commodities, a bit of a change of the narrative. Certainly Brent crude at 84, we've got WTI at 82.42, so we have seen a considerably weaker oil price this week, and that's something that the market is going to have to rethink where we go. Just, weeks, Tom, after we were asking if we were going to go to $100 oil and what that would do to markets. What do you see on the sectors?
Yeah, that conversation already seems quite a long time ago, doesn't it? And Citi, of course, coming out with a note suggesting that you can get back down to $70 a barrel. Currently, then, on the energy sector, you're looking actually at gains of 0.2%. We did flag for you basic resources leading up to the open because of the reporting that China's main iron ore base, Beijing-based iron ore buying agency, has been in conversations with some of the big iron ore producers, largely those listed in Australia and here in London as well. So basic resources getting a little lift on the back of that reporting, up 0.8%, maybe a bit stronger demand for the steel production industry of China into 2024, now getting 0.9%. Travel and leisure led the gains yesterday. That sector currently flat. We've seen autos under pressure this week, but you're adding about 0.3% on that sector so far today. It's been a bit of a damp squib for the DAX, but again, gains in the session so far, 0.3%. Financial services adding about 0.6%. Energy, as I mentioned, up 0.3%. Food is down. That's one of the biggest loss leaders across your sectors, down 0.7%. And technology was one of the biggest losers across your sectors yesterday in Europe. That's currently adding around 0.4%. Across the benchmark, gains of 0.3%. Anna.
OK, let's get the thoughts of Sam Unstead from the Markets Today blog, joining us with some of the stories that are in focus. And we talked about a few of the UK ones, so let's cast the net a little wider then, Sam. And you've got this really interesting story about the 5% bond market and what that means. I mean, there'll be many in markets look back on the period of ultra-low interest rates, maybe those who've got savings, looking forward to an era perhaps of higher rates. But there are lots of areas of pain to watch out for in the meantime.
Yeah, I mean, really just very broadly, ripples everywhere, and I think that piece does a very good job of kind of taking you through exactly where this is going to ripple through for equities, where this is going to ripple through for consumers, for mortgage holders. This is why we've been watching bonds so closely, and it feels like you guys were saying earlier that there's a degree of nervousness, leading up to the payrolls report today, got earnings season coming up. Feels like that's going to continue for a little bit longer yet. But the narrative around bonds does appear to have shifted to this watching for 5%.
Yeah, what breaks? If something breaks, does something break in this high yield environment? And I know you've been looking at credit spreads as well, widening.
Yeah.
Credit has, in the first part of this year, done quite well, and then there's been a bit of pressure coming through. But for many, it's been remarkable that spreads hadn't widened more and more quickly. That is happening now.
Yeah, it is happening now, and that is exactly the kind of ripple effect that we're trying to watch very closely, through the blog. And actually, my colleague Sophia Horta-Costa wrote about this quite a bit over the course of the last week. That's where the pain is likely to come and where it's likely to show through first. So corporate credit, something to watch very, very closely over the course of the next few weeks.
Yeah, and this week has been quite significant, hasn't it, in terms of the widening of spreads that we've seen then just this week, because up until this week, a lot of people were saying this is an area of complacency, to Sophia's point. M&A, though, in amongst all of this, the cost of money goes higher, and yet we're seeing more deals being done. Well, coming back at least a few.
Yeah, two very significant deals. So you guys already mentioned the Exxon deal. That is a very big deal. For them, it'd be the largest deal since Exxon became ExxonMobil. So that would be very significant. Sanofi as well, taking a look at Mirati, a cancer drug maker. So yes, these ripple effects are coming through, and yet we're seeing some M&A stories appear. So, as always, very hard to tell exactly how markets are feeling when that narrative is in the midst of changing.
Yeah, and it's interesting in the context of some more Bloomberg reporting about corporate debt issuance in the US. We touched on European debt issuance yesterday in the show, and corporate debt issuance in the US still continuing at a pretty impressive lick and pace, despite this high yield environment. Sam Unstead, thank you very much indeed, of course, from our Markets Today blog. You can get more from Sam and the team on the front page of that Bloomberg UK website, or by typing TLive Go on the terminal. Here's what else we are looking out for today. No big surprise. Top of the list at 1:30 p.m. We're going to get US September jobs report. Of course, economists, as we discussed, expecting a gain of about 170,000 non-farm jobs following August's increase of 187,000. At the same time, we're expecting to see the Canadian unemployment rate coming out as well. Economists expect that figure to come in at 5.6%, up from the month before. And at 1:45 p.m, the EU leaders' press conference takes place, where we may hear details on renewed support for Ukraine. Getting a couple of lines through on some of that support from some individual countries. Maria today, of course, on the ground for that. Also, topics in focus for those EU leaders: migration and Chinese EVs, Anna.
Yeah, absolutely. And that migration story, I feel, maybe a little under-mentioned because there's so much happening. With Ukraine certainly a focus, the EV cars story out of China certainly a real focus for Europe right now. But whether there can be some sort of deal done on migration, that would be a show of strength, really, for Europe, if they were able to come to further agreements on the ability to sort of share the burden, if you like. So that is something to watch. I just wonder whether we get any sense of clarity from the jobs report. Obviously, as Mark was saying, people will trade around it, but will we get any real clarity? If you just look at the jobs indicators we've had of late, it's all been a mess, hasn't it, really?
Just for this week alone, it's been a tale of two labour markets. So will the NFP actually put a close to that, give us that clarity that is needed? But as you've been discussing with Mark, there's a lack of certainty as to whether or not we will get that clarity because of the backward nature of this report. But that's what we've been talking about week in and month out. When are we going to get a clear steer on the US jobs market?
Because just this week we had sort of ADP versus Challenger and Jolts, and you can dismiss some of the data and find holes in it, but then you're down to sort of picking and choosing the themes within the labour market that support your view. As Mark was saying, that's always tempting, I'm sure. So that's where we are on the labour story. Not sure if we'll get any clues, but certainly we will bring you all of the news lines around that labour market report when it drops. Coming up on the programme, we'll get further thoughts on the Fed, of course. The Fed's Mary Daly reckons the recent bond market sell-off has reduced the need for more action. More from that conversation next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years, And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, top business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
Great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. Turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, today on Bloomberg Television and Radio. Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Now believe you can get back to 2% without damaging the labour market.
9:10 if you're in Paris or Berlin. European equity markets then getting off to a decent start, I suppose, up by 0.3% on the stock 600 this morning. Let's check in on the individual stocks on the move. Joe Easton from our equities team has a briefing. Joe.
So this is how the healthcare stocks are opening up at the moment. The one that's standing out down the bottom here, Philips, down 9%, the biggest decline in a year after news of the FDA is potentially expanding a recall of its sleep apnea devices. Now, these were devices that you attach onto your face when you go to sleep, and there was issues that some of the foam that they give off causes health concerns, and that news just broke this morning, so getting absolutely slammed in Amsterdam. Sanofi, we had in stocks to watch, doing a potential deal in lung cancer. That one's slipping slightly. It could be around $4 billion they are having to spend. Haleon, GSK is selling some stocks. That announced after the close yesterday, selling shares at a discount. Novo Nordisk ticking higher. I'm not allowed to mention what the news was on that one because people still eating their cornflakes, but it is related to the stomach digestive system. Have a read about that one. A study out on Novo's Wegovy drug last night. Then in terms of some other ones, there was a couple in the UK that we had our eye on now. JD Wetherspoon's issues a trading update saying that sales up around 9% in their pubs in the last quarter. Tim Martin still seems to be talking about lockdowns and how that affected the business. Not sure why he is still going on about that, but have a read of that. It makes an interesting one. Anyway, Tribal Group, we've got a big unch again on the screen. That's not great for me, but that one has a takeover offer. It's a small education company in the UK set to rocket when it does eventually reopen. And then a couple of others I had up. Allegro, this is the Polish grocer selling stock again, another firm needing to raise capital due to worries about a potential sales slowdown. And Alstom, a 40% drop yesterday. Analysts at Citi say that one was overdone. The stock only coming back 2% this morning, though. That was after cash flow issues at the French train makers. That one is still in focus. So pretty much bit of an eclectic mix on that board. Just a quick look at a couple of rating changes. UBS, we said earlier, upgraded to outperform over Exane, and that one rises 1.4%. They say they are coming off the fence following that merger with Credit Suisse. And Goldman Sachs recommends selling shares of Norway's largest oil company, Equinor, after a rally this year. They say that one is overpriced. One more in finance, Man Group, the biggest listed hedge fund company. They're also a buy. Alex Zane, who says that active fund managers are performing better than passive index trackers. And finally, Imperial Brands, we're ending on cigarettes. Those ones are upgraded at Citigroup, who says the sell-off linked to the UK regulating smoking and reducing the legal age and potential phasing out smoking. They say that's overdone. They recommend buying that one. And that one is rising in London today.
OK, Joe Easton, thank you very much indeed from our equities team. Now, it is, of course, Jobs Day stateside. Investors are counting down to the non-farms number that will help define the path forward, at least to some extent, for the Fed. And Mary Daly reckons the recent bond market sell-off has reduced the need for more action.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there.
OK, joining us now, very pleased to say, is Dan Scott, Head of Multi-Asset at Vontobel Asset Management. Dan, thanks for joining us in the studio this Friday. Let's start there then, before we get onto the non-farm payrolls. Your view as to how much work has already been done for the Fed by this sell-off in the global bond markets?
Well, it's interesting because yesterday there was also some talk in markets about why she said, sufficient, that she didn't add sufficient to restrictive, and whether that couldn't mean that there wasn't perhaps still some more to go. I mean, the Fed's dot plot still shows another 25 basis point hike. I think what's interesting from our perspective is that in the Fed's outlook, they think that they're going to get back down to where they want to be on inflation without causing much pain in the job market, and they're not seeing employment rise much above 4%. To us, it's a rather optimistic outlook, and we'd expect more pain in markets in general with nominal rates where they are, but more importantly, and this also alluding to what Mary Daly was just saying, real rates where they are, because they are restrictive at around 2%. That's a very tight condition, and it's going to start showing up in delinquency rates. It's going to start showing up in insolvencies, corporate insolvencies. And so that's one of the reasons why we'd avoid things like high yield at the moment.
Yeah. Well, our last guest was making the point that this is leading to the market rethinking how many cuts we get next year. And so that also adding to that sort of tightening of financial conditions. Are you rethinking what we actually get from the Fed then, Dan, given what we've seen in government debt markets?
Well, I think there's been a repricing in markets that's happened over the past couple of days. And back in August, we decided to take risk off the table by moving our overweight equities back to a neutral because we thought there was just too much optimism in the markets, whether fixed income or equities. Equities looking for about 10% earnings growth next year, and fixed income really kind of, ignoring the progress that we'd made on inflation. So I think what's happening now is that this idea of higher for longer is being priced into the market. So pushing out this idea of a recession, but rates staying high. And to me, that just means policy mistake. Because if we're making progress on inflation, there's no need to have high nominal rates. Inflation coming down and maintaining those nominal rates high just increases the restrictiveness that you have in lending conditions.
We're pricing in stagflation then, maybe.
Dan, your call around a recession then, and again, you're pushing back on the soft landing narrative coming through from the Fed, the Treasury Secretary, Janet Yellen and others. Does that make the back end of the yield curve attractive then? And how do you think about the risks of, there's a risk of kind of catching a falling knife in this environment. I mean, how are you thinking about how much conviction do you have in wanting to lean into the back end of the curve?
Well, look, I think it's all a question of timing. And I think, government debt does look appealing in terms of the type of yield that you're getting. Question is when are those yields start coming back down again? And we'd need to start to see more concrete signs of the recession for that to happen. Hasn't happened yet, and so those who've been positioned, at the longer end, have been disappointed. Yeah. And in fact, the best returns have actually come from, high yield, which you wouldn't have anticipated at the beginning of the year. So it's been a pretty painful trade for those people who've been readying themselves for a recession, as quarter by quarter those recession expectations keep being pushed out. I think one thing that we all underestimated was the huge stimulus effect that we had, not just from the excess savings and the U.S. consumer, YOLO spending and keeping us all afloat, but also the fact that fiscal measures like, student loan forgiveness, Inflation Reduction Act, those all had real contributions to U.S. GDP growth. Those are now also phasing out. So it's too early to give up on the idea of a recession.
That's interesting, because some people talk about the fiscal stimulus, the fiscal impulse, as if that's something that will keep us going through tougher times. So interesting to hear your views on that. You've mentioned high yield and staying away from high yield because of your thoughts around where the US economy goes from here. We have seen this week, actually, those spreads widening, and that maybe many people thought that should have happened earlier. I mean, how much more widening of the spreads do you think we need to see, either around investment grade or around high yield? Because a lot of people talking about how that's quite tight and quite mispriced still.
Yeah, call me greedy, but I need to see the spreads widen quite a bit more before we feel compensated for the risk that we take in high yield. And this idea that high yield is actually less high yield than it used to be because there's lots of corporates in there that, are fallen angels. I think, if we go into a recession, we're going to see spreads widen, and you need to see more than 800 basis points before high yield is a screaming buy. So I think there's some ways to go on high yield. On the other hand, if you take a look at emerging market debt, we think you are being compensated for the risk you take. So it's not as though there aren't any opportunities in fixed income markets and that you should just hunker down and have a completely defensive positioning. But at the moment, as we wait for further, like today's data on jobs, as we try and wait and see the clues on how the economy goes, probably it makes sense when you're looking at the flows in the market and how so many people have just been hiding in money market funds.
And Dan, I mean, to that point, you say, and you put in your note to us, we love EM debt.
Yeah.
Do you need a softer US dollar to have that level of conviction around emerging market debt?
A soft US dollar, of course, helps. I think what's different to past, cycles is that emerging market assets, be they equities or debt, have always been a terrible place to be if you're going into a recession. So it seems a bit counterintuitive to be a fan of emerging market assets at the moment. But the difference is that you wouldn't want the benchmark because you want to be selective about which countries and emerging markets you're positioned in. Some of the best performing currencies have been Mexican peso, Brazilian reais, and the reason being they were ahead of the game in raising interest rates, and now they're in a situation where they also don't have the type of dollar funding stress that they did in previous cycles. So commodity prices and commodity exporting nations in emerging markets, I think, are in a very strong position. And then also the shifts in global geopolitics puts Mexico in this strong position. The amount of remittances they have, the nearshoring benefits that they're enjoying, these are all structural, long-term supports for countries that are beneficiaries of nearshoring, friendshoring, and they're not just in LATAM. If you look at Vietnam or Indonesia, also economies that are huge beneficiaries.
Yeah, really interesting then, the EM friendshoring geopolitical link. Thanks very much, Dan, for joining us. Really nice to see you and speak to you. Dan Scott, head of Vontobel Multi-Asset at Vontobel Asset Management. Coming up on the programme, Shell says earnings from gas trading rebounded in the third quarter. We take a deeper dive into the energy giant's shift pivoting back towards fossil fuels. More on that. This is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupied areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Welcome back now. Shell says its earnings from gas trading rebounded in the third quarter as Europe's appetite for LNG remains high. Joining us now is our big oil reporter, Laura Hurst. Laura, walk us through these numbers that came through from Shell then.
Well, Shell doesn't give us a huge amount of information in these trading updates. It just says how the segments are doing compared to the previous quarter. And it's saying that gas trading, which can give quite a lot of money to the business, has gone up. There's a lot of volatility in the gas markets, so that's usually when traders can step in and make a lot of money.
Okay, so that's what we've heard from them this morning. The longer-term story around Shell, really interesting, and to differing degrees it takes in other European energy companies, or some of them anyway. But this pivot, you know, we had seen this pivot towards renewables, and now, I don't know how you would characterise it, not a full pivot away, but a step away from and back towards fossil fuels. This said to be to please investors, but certainly not pleasing some of their staff. How is Shell handling this dynamic?
Exactly. It seems like there's quite a split within the company. There's a big segment of the company that are very happy about the pivot back to what they view as, well, what is their core, oil and gas. But having made this big push into renewables, now they're decelerating with the new CEO, Wael Sawan. And a lot of people are unhappy. We've seen some sort of departures in that part of the business, and a lot of dissent. So they're going to have this meeting in a couple of weeks to talk about that and see if they can satisfy people's worries.
So it's a tension between some of their employees and their expectations and aspirations, and shareholders who are rewarding Shell for this pivot back to the core part of the business. How does this play out, do you think, in the months ahead? BP with a similar U-turn, maybe is too strong a word, but at least reassessment in terms of how far it wants to go into the shift into the renewables.
Yeah, absolutely. There's been a deceleration, and so far the market's like that because the bulk of the earnings from these companies come from oil and gas, and oil and gas prices have gone up. There's a lot of volatility. We're going into a winter where we don't have Russian oil and gas supplies as we did a few years ago. So that's really where the money is. And even investors like Dan Loeb, who'd previously called to split up the company, they're saying, actually, we're really happy with this. The new leadership is completely focusing on shareholder returns, and that's what we want.
Yeah, Sahara-like conditions across Europe this year, not changing the view of investors as they look for those shorter-term returns. Laura Hurst, thank you very much indeed on the numbers coming through from Shell and that tick-up in gas trading. We appreciate it. Coming up, Ukrainian President Zelensky looking for concrete pledges from his European allies amid concerns about the continued flow of US aid. We are live on the ground in Granada at that EU summit. You can see there Josep Borrell speaking to reporters. Plenty more coming up. This is Bloomberg.
politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more, but
That's optimistic.
And Joe Matthew.
the debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. We're 30 minutes into the European trading day this Friday. Here are your top stories. Global equities and futures are mixed as investors wait for the latest US payrolls print. The Fed's Mary Daly says rates can hold steady if the labour market continues to cool. Seeking support, Ukraine's President Volodymyr Zelensky urges the EU to stay united in the face of Russian aggression. We're live from Granada, Spain, as European leaders meet. Plus, Bloomberg has learned that Exxon is in talks to acquire the shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals of the year. So, Tom, a little bit of M&A to talk about, a bit of spread widening on corporate credit as well, adding to some nervousness for some investors. The bond market firmly in focus, and its reaction function to the jobs report later will be interesting to watch.
Yep, so yields ticking up just marginally, 1 to 2 basis points across the US Treasury curve and in Europe as well. But it's a slightly more level of conviction, slightly higher level of conviction across these European markets. Maybe there's a bit of a bet going on that those non-farm payrolls will come in below the estimates. But you're seeing gains of 0.5% across the benchmark. Again, the estimates are that you're going to get a print of 170,000 non-farm payrolls for the latest month. So coming in from about 187,000 the month before. Of course, consequential is a little bit backward looking, doesn't include some of the strike action, but nonetheless a key data point for investors later today out of the US. The DAX currently adding 103 points, up 0.7%. The auto sector doing a little bit better in the session today. The FTSE 100 trying to get to that 7,500 level, not quite there yet, adding 29 points. The miners are in focus, given that we know that China has started a conversation with some of the main oil producers as they focus on that steel sector looking to 2024. We're also, of course, keeping an eye on what's happening in oil, the energy price. Oil ticking up a little bit in the session today, but of course for the week you're looking at downside in terms of prices for WTI of around 9%. Across your sectors then, let's flip the board and have a little look across those main sectors then, because there is green generally across the main sectors. One sector remains in the red is food and beverage. That sector currently down 1.5%, taking a bit of a hit in the session so far. Utilities is flat. Autos then gaining after a challenging week for that sector, adding a full percentage point, 1% there. Banks also doing fairly well, adding 1.13%. Financial services in similar territory. There's the energy picture then, despite that slump in prices that we've seen this week. A little bit of a gain for the energy sector, up 0.6%. Basic resources, talked about this, the China factor, of course, 1.2% is the add there, and technology gaining after being one of the biggest losers yesterday in the session in Europe. Technology is a sector adding 1% across your benchmark gains of 0.5%. Anna.
Okay, so let's get from the markets to the politics. EU leaders are gathering for a second day in Granada in Spain after the Ukrainian President Volodymyr Zelensky urged them to stay united in the face of Russian aggression. Meanwhile, the US ambassador to NATO, Julianne Smith, sought to reassure European allies, telling Bloomberg, quote, the US is not going anywhere. For more, let's bring in our European correspondent, Maria Tadeo, who's on the ground for us in Spain. And Maria, it was a wider European family that met yesterday, a narrower body, the EU today. Zelensky has been on the ground talking to European leaders, making this diplomatic effort. What has he achieved?
Yes, Anna, and of course you alluded to that interview that we did yesterday with the U.S. ambassador to NATO, very much sticking to the script. She did concede that, of course, there is an ongoing situation, which she said is a temporary situation when it comes to funding for Ukraine, but she also told me Biden made a promise to help the country, quote, for as long as it takes, and the United States will do exactly that. The issue, of course, is that there are doubts, given some of the political volatility that we've seen play out in the U.S., and President Zelensky, who was here, as you say, yesterday on this diplomatic offensive, so to speak. He was here for less than 24 hours. We should make that clear, had a number of bilateral meetings. He also conceded that it is worrisome for Ukraine, the situation that's going on in the U.S. As a matter of fact, yesterday when the session ended, we got called to a room to speak with President Zelensky. One of the questions that was put to him by a number of small reporters, and we were there, was, do you fear precisely that we're seeing perhaps the end of the Biden doctrine? And he said, of course, that is a dangerous situation. He gets very much that this is an election year in the U.S. He said there are, quote, some strange voices, too, in U.S. politics, but he also stated that for Ukraine, there's not been an easy day ever since the war started. So, again, a lot of that permeating in the conversation here. On that note, Zelensky also told European leaders gathered yesterday that Europe will have to help, perhaps even more so if we do see that backtracking from the United States. That was on the diplomatic side of things, but there was also a conversation about the logistics and the needs of this country. We know that the counteroffensive continues, but we also know that winter and the fall is around the corner. And for Ukraine and President Zelensky, what they worry is that we could see a repeat of what happened last year when Russia increases the pressure on the air. We know that Ukraine does not have superiority in the skies, and they fear is that they could again target some of the strategic infrastructure that could affect the electricity, the heating, and send the country back into blackout. That happened last year. So one of the calls that was made from President Zelensky is that he will need more air defense from now until the winter to get through the winter. So you see there's almost a twofold conversation. One about the geopolitics, the diplomacy that goes on behind the scenes, some of the concerns openly acknowledged by the Ukrainian president, but also the reality on the ground in Ukraine, which continues, of course.
So the added urgency around that need for continued support from Europe, given, as you say, the volatility, the cracks that are appearing in the body politic of the US. What about the cracks? What about the volatility in European politics? How aligned are leaders on some of these other subjects beyond Ukraine, Maria?
Yes, Tom, and also the focus changes today because yesterday, not to get too technical with some of the terms here, but it was a European political community that met. These are continental European countries, and today is specifically about EU 27, so the European Union that gathers here for this summit. It is also interesting to note that this is the first time they meet since the summer break, but also the first time since the European Commission announced that probe into EVs coming from China. So today there will be a discussion about the economy, migration to becoming a very political topic here in the EU too. We saw yesterday, by the way, a meeting between Giorgia Meloni of Italy and Rishi Sunak in the UK, both stressing that there needs to be a tougher line on migration. So sometimes we talk about the tensions between the UK and the EU on that front, but when it comes to migration, the Prime Minister has found an ally in Giorgia Meloni of Italy. And of course, the other question going into the summit today will be enlargement. Remember, this is a very active conversation. There's a number of countries, including Ukraine, by the way, that have applied to join the EU. There's an active debate as to can that happen and just how fast. Remember, the Council says maybe by 2030 that could happen. It seems a long way off, but actually, if you look at the many reforms that entailed and just how technical and difficult this process can be, some say maybe this is too ambitious.
Okay, Bloomberg's Maria today on the ground for us in Granada at that EU Leaders Summit, and will continue to bring us the latest lines from that important meeting. Maria, thank you. Now, some of America's best-known brands, a bit of a switch of focus here, are declaring bankruptcy after years of cheap borrowing. The Fed's inflation fight has pushed up, of course, interest rates and made the price of debt more expensive. Bloomberg's Sonali Basak tells us what this means for the economy and which industries are most at risk.
Debt is piling up. Companies are filing for bankruptcy now at the fastest rate since 2020.
The record surge in interest rates is at the root of the issue. Global companies have borrowed more than $500 billion of investment-grade debt since the Fed's rate hikes began in 2022. The vast majority of this was heaped onto U.S. balance sheets. And despite the high borrowing costs, debt continues to grow.
It's really been building over the course of the last year. Interest rates have increased. Cash flows have declined.
By mid-2023, blue chip names saw their borrowing costs rise by more than double to an average of 5.6%, while junk-rated companies were paying 8.7%.
The problem is, in part, that this is a little bit by design. The Federal Reserve wants to slow down inflation. Interest rates were kept higher for longer than a lot of economists and people on Wall Street expected.
This higher rate environment has created a mountain of distressed debt.
Since 2021, this sort of debt, owed by riskier, less creditworthy businesses, has jumped around 400%.
For consumer-facing companies and those upstream supplying them, that will impact their businesses, and those can be pretty difficult, particularly if they have a lot of space. The appetite for risk has declined a bit. There's less capital available to companies, particularly those that are growing.
From the post-war economic boom in the 1950s to its high point in the 80s, interest rates have always fluctuated with the times. But the near-zero rates of the last 15 years following the great financial crisis have hardly been the norm. The problem is, when companies aren't put off by higher rates and keep borrowing, it may be a sign that the Fed still has more work to do to bring down inflation, which increases the odds that someone will get caught off sides and left to take the hit.
Sonali Basak reporting. You can find more on that story, of course, on the Bloomberg website. Now, coming up on the programme, China opens talks with miners for next year's iron ore supply. What impact does that have on the market? A bigger player at the table from the Chinese side whilst talking to these mining businesses. We'll talk about commodity markets next. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
This is Markets Today, 8:43 here in London, so 43 minutes into a European trading day that, yes, actually goes a little bit higher, just as US equities recover a little, just flat, though, heading towards that non-farm payrolls report a little later. Here are some of the top stories that we're covering on the Bloomberg terminal this morning. The US Securities and Exchange Commission is seeking to force Elon Musk to testify as it investigates the billionaire's purchases of Twitter shares ahead of his takeover of the social media platform. Before acquiring all of Twitter, Musk first purchased a 9.2% stake in March of 2022. He then disclosed the stake to the SEC in April. The agency's rules require most people who buy more than 5% of a company to disclose it within 10 days. The SEC says Musk failed to appear to testify last month as requested and asked a judge to force him to appear.
Now, FTX co-founder Gary Wang has taken the stand at Sam Bankman-Fried's trial, saying immediately that he and his former childhood friend and MIT roommate committed a multi-billion-dollar fraud. Wang is cooperating with prosecutors after pleading guilty to fraud. His testimony promises to be among the most powerful in the government case against Bankman-Fried, who has pleaded not guilty.
British Airways reached a tentative labour agreement with unionised pilots yesterday, removing the threat of a walkout and averting the chaos previously seen at UK airports. The new deal improves pay and working conditions, just as parent company IAG announced better than expected second quarter earnings in July. Pilots will vote on the offer in the coming weeks, with a deal subject to the outcomes of the ballot.
Now to geopolitics, and the US and China are said to be moving closer to setting up a meeting between Presidents Joe Biden and Xi Jinping at next month's APEC summit in San Francisco. Sources say both countries have been scouting meeting sites in the city. Biden and Xi have not spoken since the G20 in Bali last year. Neither side has confirmed the meeting. And staying on the China story with a bit of a different pivot, Bloomberg has learned that China's state-owned iron ore buyer is in talks with miners over next year's supply. China Mineral Resources Group is said to be seeking preferential terms on transport grades and delivery arrangements. Let's get more then from Clara Vieira Marquez, who is Bloomberg's managing editor for commodities and energy in Asia. Clara, how significant is this? We're seeing some of the miners getting a bit of a lift to the stock price. It seems on the back of this news, at least listed here in the UK. What is the significance? What does it tell us or indicate around demand coming from China? Okay, it seems like we have lost connection. It happens with live TV sometimes.
It's never good when someone's got their hand on the earpiece, is it?
It's a signal, isn't it?
You can always tell.
So we're going to try and reconnect the connection with Clara. But what's important is, again, we're seeing this, I kind of phrased it as part of the question, is that we are seeing a bit of an uptick. The expectation, so you have this big grouping. Yeah. This was changed by Xi Jinping, by the team in Beijing a couple of years ago, to basically give the Chinese more clout in terms of the buy of iron ore from the likes of Rio Tinto and other largely Australian miners, frankly, when it comes to iron ore, for that huge, of course, steel production economy that they have in China. And the idea is they want to have a bit more leverage.
Yes, and doesn't seem as if that should be good for mining stocks.
No, you wouldn't have thought, but the expectation is that maybe this suggests they are starting to plan for a bit of a pickup in terms of iron ore production and steel production, I should say steel production, using iron ore inputs in 2024. But Clara, let's bring you in. I think we've reconnected now with Clara Vieira Marquez over in Hong Kong. Clara, so what is the significance of this then?
So China has been, as you know, as you've just mentioned, a very, very big buyer. So they 3/4 of the world's iron ore goes into China's steel industry, the world's largest. They have for a very long time been a price taker, not a price maker. China has for a long time wanted this extra clout, so they set up CMRG last year, but it has been a very slow start, slow to get the steel mills on board and slow to get the companies engaging. And what we've learned now is that they are in talks with the 4 largest, the companies that really dominate the iron ore supply, and they are speaking on behalf or negotiating on behalf of some very large steel mills. So this is the clout result that we've been waiting for. Whether it has an impact on prices, it's a little early to say because the contracts are still, as they stand, based on floating benchmarks. Where we might see some change is on the terms and conditions.
Yeah, this is interesting, isn't it, Clara? Because on the one hand, you might have thought if it does have an impact on prices, it improves the terms that China can achieve, and so is bad news for those mining companies. But on the other hand, as Tom was making the point earlier, this perhaps suggests that China is ready to deliver something better on the growth front, and so that would be positive for mining businesses.
Well, China's coming back from a week-long holiday. The stockpiling before the holiday wasn't particularly bullish, so perhaps people are seeing in this something a little bit positive to come into next week when China resumes trading. Certainly at first glance, it is a little surprising to have seen them go up, but, you know, not that much, and a lot remains to be seen.
Yeah, and iron ore price is currently down in the session, actually, 0.4%. Clara, give us if we zoom out and the bigger picture in terms of the metals and commodities demand coming from China. There's expectations now. This is a week where we've had Citi and other economists actually revising up their forecasts for China's growth. As you say, when China comes back from holiday, we'll get a bit more data in terms of the consumer spend. What is your expectation? How much detail do we have? How much clarity do we have around the demand impulse from China for some of these commodities going forward?
Well, remember, it's not just China that counts. The export markets are very, very important for China. So what Europe does is no less important when you look at things like base metals, which might explain why copper today is as low as it is, coming up to this, I think, the lowest since the end of last year. So when we come back, where we might see a little bit more positive movement is in the construction side, if we do see that begin to pick up. Retail perhaps remains a little tentative. We will see. It is a very, very mixed picture. Certainly not as grim as some had expected a few months back, but not quite the recovery many had hoped to see after the Golden Week holiday.
Clara, thanks so much. Bloomberg's Clara Ferreira-Marquez speaking to us, of course, from Singapore, as you'll have noticed on the screen. Let me just tell you that we are getting some pictures coming to us from this EU Leaders Summit that is taking place in Spain. Ursula von der Leyen, of course, the Commission President, speaking at this moment. We will just listen in a little to hear what she has to say.
Progress in Georgia. Lots has been done. A lot is still to do. So the main message is take the opportunity now, give it a push forward, and be very clear in the reform process and the policies that we have agreed.
Madam President, what's your message to countries here?
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Markets Today, 8:53 in London, so 53 minutes in to Friday, and European equity markets go a little higher, actually, waiting for non-farm payrolls. US futures are flat. Let's talk about what's happening in these markets. Eddie van der Veld joins us from the Markets Live team. So equity markets actually gaining on a day where typically you might see people not wanting to commit ahead of important data, the jobs report, Eddie.
You know, I love these quiet moments in markets before big things happen, because the direction that you drift, to me, tells you a lot about where underlying sentiment is. This is what people will do if nothing's going on. So it tells you that there's, you know, mildly bullish sentiment underneath all of this. And I think there's good reason, you know, for markets to be a little bit bullish, particularly if we look at, you know, things like oil prices that are coming up and taking some of the sting out of inflation, maybe.
Well, on that oil story then, and you're right to flag it, because we've been talking about the fact that WTI could end the week down about 9% in terms of prices. Currently at $83 a barrel on WTI, and it's up about 1% in the session today. But then you have the story around Russia allowing some diesel exports onto the global market, it seems. What's going on? Is it significant for the energy markets?
It absolutely is. So you see, I think what's been driving... So what a difference a week makes, right? A week ago, we were talking about $100 oil, and everybody was panicking, and this was going to fuel inflation, and so on and so on and so on. And then, you know, you're starting to see, because we had this big backwardation with near-term prices so far above longer-dated ones, you saw supply coming forward. You saw supply coming out of storage, probably, you know, taking some of the sting out of prices. At the same time, diesel was a big driver of prices because jet fuel was in demand. That made diesel expensive. Russia, you know, threatened to disrupt the market and is now pulling the plug. And I think because of all of those factors, and the fact that oil has really just been bolstered the year so far by higher, you know, by Saudi cuts and so on. So all of it on the supply side. And if those things start to disappear, then I think the inflationary impulse just weakens.
Yeah, it's really interesting how the conversation has gone, you know, really pivoted from a real focus on the supply side and what the Saudis are doing to actually the demand story, add into the mix the diesel messaging from Russia, and it gets more complicated. Let me ask you about the rising yield story. I mean, this week's been incredible in bond markets. We've talked about this already. Eddie spent much of the time on the show talking about it. But the broader drift higher in yields and where we land, how long we spend at elevated levels, really coming home to roost for a lot of people, and a lot of people asking what breaks.
And really, those are two stories, right? One is the steepening of the yield curve, which is significant, and it's all coming via the back end. And it's not something that markets are used to. People have traded a steepening yield curve where the front end comes down when the recession hits. They don't know how to trade the long end, you know, because we don't really have the data. At the same time, you're seeing the 30-year yields just breaking a chart that has been in downtrend for 30 or 40 years, right? I think that's probably the most significant chart, that downtrend, long-term downtrend in 30-year yields that have faded away. So big moves in markets at the moment.
Okay, Eddie van der Veld walking us through some of the key market things as we lead up to that non-farm payrolls print out of the US. Thank you from our Markets Live team. Of course, remember, you can get up-to-date analysis and insight from Eddie and the rest of the team. Just go to MLive, go on your terminal. Anna, currently European futures adding to gains about 0.5%.
Yeah, absolutely. Really, European stocks up 0.5% on the stock 600. The FTSE up 0.4%. We're working our way towards non-farm payrolls, of course. US futures have actually just turned up into the green, so up 0.1% on NASDAQ futures. Plenty more payrolls coverage and countdown coming up. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In
January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. ON's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Traders prepare for a U.S. payroll print forecast to show hiring slowed last month. The Fed's Mary Daly says rates can hold steady if the labor market continues to cool. We're live from Granada, Spain, where EU leaders will be laying the ground for the bloc's strategic agenda. Ukrainian President Vladimir Zelensky urges them to stay united in the face of Russian aggression. Plus, Bloomberg has learned that Exxon is in talks to acquire shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals this year. Now, first of all, happy Friday, everyone, because I know it's been certainly a roller coaster of a market, a roller coaster of a week, especially if you've been trading in fixed income. Let's take this Friday morning a look at the European markets map, a little bit more of stability, but we have a number of stories on the Bloomberg terminal that are, of course, great reads. For example, looking at the 5% bond market and what that means in terms of pain heading everyone's way. In terms of what we're seeing across the board, so we're seeing slight gains, nothing huge, nothing to write home about. We are seeing a little bit of gains across the board. European stocks edging higher, but it's all to do with the U.S. jobs data. Hoping, of course, we'll have a bit more news of whether there's more pressure to come from the Federal Reserve or whether that eases a touch. Now, miners amongst the best performers in the Stock 600. There's news that China's iron ore buying agency is in talks with some of the global suppliers. Look out for VIX after the week that we've had. And, of course, the big one is a 10-year. This is what happened to the 10-year yield over the last 20 days. Now, just over an hour into the European session this Friday, let's also take a look at some of the movers with Joe Easton from our equities team. So, Joe, happy Friday. You're talking bowels and you're talking insurance.
Yeah, we've got an eclectic mix for you today, Fran, but we got some decent moves this morning, starting off in Amsterdam. Philips getting absolutely slammed. That's the biggest decline in around a year. The US FDA announced last night that they're expanding their inspections of Philips' sleep apnea device. Now, as a reminder, this is a product that people would attach to their mouths while they slept, and it emitted a certain foam, and there was concern that that could potentially have negative health impacts, and there was a big recall. The FDA saying that they will now expand testing following further investigations. That's ticking even lower now, down the most since November last year for the medical tech company. Then we're going to flip over, look at something completely different. We're going to look at insurance, because Aviva in the UK, one of the best performers in London at the moment. Now, this seems to be stemming from a blog post on a website called Betaville a few days ago, which reported potential takeover interest. Now, the Times has followed up on that. The Times of London reported something similar. It's all very vague, but that stock now trading at a 5-month high. It's the UK's biggest general insurance company. So they do life insurance, car insurance, pretty much everything. Takeover interest circling among traders, unconfirmed at the moment, and we've reached out to Aviva for a comment, so we'll wait to hear back from them. Then finally, the staple goods sector. Now, you referred to the Wegovy, the stomach drug, earlier just now in the build-up. I'm not going to talk about bowel movements, thankfully, but the staple goods are declining because Walmart said after the close yesterday, or late trading yesterday, that they're seeing a decline in some sales of some goods, and they're saying that might be due to the Wegovy appetite suppressant drug from Novo Nordisk, and that's feeding through, according to traders that we've been speaking to. That's what's weighing on Unilever and Nestle and a bunch of other staple goods, the companies that supply supermarkets with all these staple food products. Now, I would note that we're also seeing a decline in AB InBev. I haven't got that one on the screen, but AB InBev is declining, the maker of beer. So that brings into question, is it really Wegovy driving that? Because Wegovy is more related to suppressing food, not alcohol. Potentially questioning that. Maybe it's more of a rates move, but definitely an interesting story.
Yeah, a lot going on in fixed income, a lot going on in currencies this week, and on a Friday, even a lot going on in some of the stocks. Joe Easton, thank you so much for a terrific roundup. Now, we're, of course, watching U.S. payrolls later today, how that'll impact markets, especially treasuries, after the brutal sell-off. For more, we're joined by Naila Richardson, chief economist at ADP, as well as Laura Cooper, senior investment strategist at BlackRock. So thank you both for joining us. Laura, how are we doing? We surviving the week? I mean, it was pretty volatile. It was like a bit of a roller coaster. And again, it's unclear what crystallized the fears in the markets.
Well, I think certainly the price action around this rates repricing towards this new macro regime of higher inflation has really been the most pronounced move. And I think the question that we've been facing from clients is, where is this endpoint where we're going to start to see buyers coming in? And we really question the fact that, rates are likely to go even higher above that 5% mark, because if we look at the term premium, it's only positive about 30 basis points now based on some models. There is scope for it to go higher, even if we see bouts of volatility as some dip buyers return.
I mean, the market sometimes is ahead of the curve and sometimes it's really behind. So we have a number of stories saying, look, this is what breaks if we set 5% for a longer time, maybe a much longer time. I mean, what happens at 5.5 or 6%? Is there something that you need to sell off or take stock of right now?
So clearly the U.S. economy cannot withstand rates at that level, particularly when the moves have been driven by real rates and the fact that we do have that 10-year rate with a 2% handle. We're already seeing that in terms of a slowing in consumer discretionary spending. That's likely going to be the key trend next year. If we think about mortgage rates are sustainably already above 7%, mortgage applications for new homes have fallen to multi-decade lows. So we are going to see the consumer come under pressure in this backdrop of tighter financial conditions. And that really raises the question of how long can the Fed keep rates in restrictive territory? It's less about another 25 basis points or so. It's when will they actually ease policy next year?
Now, this is the million-dollar, trillion-dollar question, but in the meantime, what happens to credit? What happens to actually households having to repay debt in the U.S.?
Well, let's start with the labor market, because what's different about a Fed tightening cycle is that we still have a strong labor market. So there is some support for the consumer in the U.S. When it comes to the credit market, obviously borrowing costs have gone up. You've seen housing come to a virtual standstill, not because there's not demand out there. There's no inventory. Most homeowners are locked into a 3% interest rate, or definitely below 6%. So it makes no sense right now to financially put your home on the market and trade to something else. That's what's brought the market to a standstill, not the lack of demand. So the consumer, yes, it's slowing, but it hasn't gone to a standstill yet in a way that tips into recession. I think that's an important point.
So yet, and yet is extremely important, because if you look at hiring, so the labor market is strong, but they're not hiring that much, especially in the private quarters.
Well, large firms aren't. If you look at the ADP report, which is about 20% of the U.S. workers in the private sector, what you see is an interesting dichotomy between small firms and large firms. Large firms hired aggressively last year. They started pulling back, and we saw those announcements of layoffs late last year, early this year. You're still seeing weakness in large firms, but small firms have been hiring, and that's very interesting because you would think that smaller firms were more sensitive to the rate environment we're in now. They're not showing it in their hiring yet because they're still trying to get their headcount up and grow their businesses, and that is a good important signal that's often missed in the markets. These small firms aren't part of the market, so it's easy to overlook them.
Yeah, that's such an interesting point. All right, this is one of my favorite times of the early mornings, and it's the big number. So every day we choose a big number. Thank you, Dan Tillis, for always coming up with an interesting number. Now, this is the gap between the survey and the whisper estimates for today's U.S. jobs report. And the difference between that is 20,000. So if you're wondering what the whisper is, it's basically the sweepstake that Laura does at the office, right? That's how we calculate the whisper. I mean, how important is this job? I know every month it's important, but again, I feel like it could be a watershed potentially moment for the markets.
So I think we're going to need to see a significant deviation from that consensus, even beyond that 20,000 whisper margin, because ultimately this is, a market that is looking for, is the bad news going to be good news? And could we start to see more of those rate cuts that were previously priced out start to be priced back in? We will be watching, though, the unemployment rate and labor force indicators beyond just the payrolls print, because I think clearly that trend of hiring is slowing. The unemployment rate, what we're looking for is the labor force dynamics around, are we going to see more workers return to the workforce? Because it's really been that structural shift where workers have left that have kept wages elevated. We're expecting our average hourly earnings to tick higher again today. That's a crucial input into this overall environment where inflation is likely going to be higher through next year and over the medium term.
And Nela, so first of all, I do love this because probably every office around the world is, putting sweepstakes on rugby matches and football, and here we are with the non-farm payrolls. But how quickly, or what's the earliest that you think the Fed could cut interest rates?
I think we're a ways from a cut. If you look at
not next year,
maybe, but not in the first 3 months of next year, which is what some in the markets were thinking, that this would be an over and done a rate hike by now. But if you look at the labor shortages that you're seeing that are structural in nature, it does keep a floor on wage growth. We are seeing wage growth decelerate. I think that's the number to watch rather than the jobs number, which that 20,000 whisper, that's not even close to the revisions we've seen coming out of these numbers before. But if you look at wage growth, it's been a steady decline. That's great, but it's likely to stay inconsistently higher with 2% inflation. And that is the rub for the Fed. All the numbers are moving in the right direction, but they're not moving fast enough back to that 2% target.
Yeah, Laura, how quickly do you think that the Fed can reverse course? I mean, I know it depends on the strength of the economy, it depends on energy prices, but do you push it back?
So at this point, we are penciling in a Q3 rate cut next year. And I think the crucial thing is that in the near term, markets have priced out the next rate hike if we do see a strong print come in today. So there is scope for the move that we have seen in yields to extend and even reverse more of this bull steepening rather than the bear steepening. And I think that's really crucial to watch for around the next recessionary indicator, because timing that downturn has really been the most challenge facing strategists and commentators.
All right, so thank you both for joining us. Nela Richardson, Chief Economist at ADP, Laura Cooper, Senior Investment Strategist at BlackRock, both stay with us. Also, Bloomberg has learned that ExxonMobil is in talks to acquire the shale-focused Pioneer Natural Resources. Now, the deal is huge because it's worth some $60 billion, potentially the largest acquisition of the year. It would make Exxon the top producer in the most prolific U.S. oil basin, talking shale oil. It would also make one of the largest oil companies in the world even bigger. Now, pre-market trade, Pioneer, you can see 10% higher, Exxon down 2%. Much more ahead, and this is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there.
The Fed Bank of San Francisco President Mary Daly there saying policymakers can hold interest rates steady if the labor market and inflation continue to cool or financial conditions remain tight. Now we're back with Neela Richardson, chief economist at ADP, and Laura Cooper, senior investment strategist at BlackRock. Okay, so the treasuries are all over the place. Do you buy anything right now? We also had a story yesterday saying issuance in 2024 may be tricky because there's just so much of it.
And the issuance next year is one of the key reasons why we're not extending duration in our positioning. And if anything, yes, we saw the term premium, as I mentioned, about 30 basis points for that 10-year tenor. Back in 2021, we saw about 3 months of that where it's close to that peak, and then we saw this renewed bids and a sharp compression. But we don't think that's going to be the dynamic this time around. So instead, we are seeking short duration exposures in treasuries. But there's more opportunity, we think, if we look, for example, real rates. The fact, we think that's quite an attractive opportunity, given this is an environment where U.S. economic growth is slowing. But it's about looking for opportunities elsewhere. So looking at the European bond space, which has really been caught up in the spillover effects of the Treasury sell-off, we think at these entry levels it's quite attractive because the growth and inflation dynamics are materially different than what we are seeing in the U.S.
Yeah, interesting. We've had some really big moves also in Europe. Now, when you look at 6 weeks ago, I think it was all about China and concerns about China and the slowdown in China, what that means to the rest of the world. Now we're focusing on the U.S., but globally, what do you worry most about?
That inflation, even if we get it back down to a more comfortable number for all of these global central banks, that it's not going back to where we were before the pandemic, 10 years of slumber. That these central banks, no matter where in the world they are, they have to be much more careful about inflation and its effect on growth. And so it's not just a one-year story going forward. This is a multi-year, probably through the next decade. If you look at labor shortages in advanced countries, if you look at a hopefully growing China and the geopolitical concerns that leads to higher inflation or higher oil prices, all of that adds up to a different picture for the global economy structurally than we saw before the pandemic.
But, if you look at, I guess, supply chains, but also this was started under the presidency of Donald Trump, right? The fact that a lot of the supply chain changed because he moved away from China. Are we there, or is there still quite a lot of deglobalization or de-unpacking to do?
I think we're seeing a reshuffling of supply chains, trying to produce the resiliency that won't be disrupted by events around the world. But that resiliency comes at a cost, and that cost could be higher prices, which feeds inflation. So definitely a different type of supply chain policy or strategy for companies going forward.
Anything else, Laura, that you like? I don't know whether you're looking at. I mean, yen also gave us a little bit of a scare, certainly a bit of attention this week.
So in the equity space, I mean, we do still like Japanese equities because we are seeing this inflationary regime shift there as well. But we are taking a more selective and granular approach if we look at U.S. and European equities. So we think tech leadership can persist. We've seen 3-month earning revisions become quite strong. That's an area that has those defensive properties, but as well more of that pricing power in this inflationary environment. And in Europe, it's about looking for those industries that, yes, they can be cyclical in nature, but they're not necessarily acting cyclically. So energy, for example, we think is supported by supply-demand dynamics, and as well industrials, given where we are in the decarbonization cycle and the capital expenditures that we do expect going forward from the transition.
Thank you both. That was really, really fun joining you. Actually, also, even if it was a pretty big news week. Laura Cooper from BlackRock and Naila Richardson from ADP. Now, coming up, Bloomberg understands that Exxon is in talks to secure what could be one of the year's biggest deals, so we'll have the details next. And this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. There's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
More on the story we told you a little bit about earlier. Bloomberg learning that ExxonMobil is in talks to acquire shale-focused Pioneer Natural Resources in a deal worth as much as $60 billion. Now, it's potentially the largest acquisition of the year. You can see pre-market, Pioneer gaining 10%, Exxon down 2%. Now, joining us is Bloomberg's oil and gas reporter, Laura Hurst. Laura, this is huge. Thank you so much for coming in. I mean, this is worth like $60 billion. What's the logic behind a deal like that, and how does it actually fit with the Exxon strategy?
Well, Exxon has been on the lookout for deals in the Permian, which is that shale basin in the U.S. And so they just haven't had the right timing because of the coronavirus pandemic. But what that allowed it to do is cut costs severely. So now it's got a lot of cash, oil is back up, and it's a good time for them to buy.
We used to talk. I feel like every couple of months we talk about oil at $100. Is it now more or less likely?
Well, there was a lot of talk about that earlier this week when OPEC Plus scaled back production. But that sort of had a bit of an adverse reaction in that products, gasoline, consumption has started to go down. And there's talk about demand destruction as a result. So it might have not had the intended consequences from OPEC Plus.
Laura, Shell. So Shell is higher this morning. The company said that earnings from its gas trading rebounded in the third quarter. The new chief executive is not without controversy because he's also just bluntly saying, look, they want to be less green. So how's that playing out with shareholders?
Yeah, so it's a mixed bag. Of course, you've got environmentalists and more green-minded investors who don't really like the change. But then there are a lot of them like Dan Lode, the activist investor at Third Point, who's saying the company is doing great, they're focusing on returns, and that's what we really need right now.
So what are you focusing a lot of your reporting on? Again, there's OPEC Plus, there's this mega deal with Exxon and others. Do you think there's going to be more M&A, or is it just a retrenching? I guess everything goes back to the fact that we just don't have enough resources for what we want to do.
Well, certainly there is a lot of opportunity now for the oil majors because they have a lot of cash. They've cut their costs down a lot. Yeah. And as the war in Ukraine has shown, there's still a very big need for oil and gas. So there's a lot of talk of is this the time to now go back, increase production, increase reserves, rather than explore for oil, which takes time and is very costly.
Laura, thank you so much for joining us. Laura Hurst there, our Bloomberg oil and gas reporter. Now, some of the other news that we're watching, Russia lifting the diesel export ban that has roiled global markets. That's according to a government statement. Now, weeks after imposing the block, shipments can resume, provided that the fuel is delivered to Russia's ports by pipeline. Moscow did impose the ban after surging domestic fuel costs drove up inflation. Now, the U.S. Securities and Exchange Commission wants to force Elon Musk to testify as it investigates his purchase of Twitter shares before taking over the social media platform. Now, the Wall Street regulator said Musk failed to appear to testify last month as requested. Before acquiring all of Twitter, Musk first purchased a 9.2% stake in March last year and disclosed it the following month. Well, the SEC's rules require most people who buy more than 5% of a public company to disclose it within 10 days. And FTX co-founder Gary Wang has taken the stand at Sam Bankman-Fried's trial, saying immediately that he and his former childhood friend and MIT roommate committed to a multi-billion-dollar fraud. Now, Wang is cooperating with prosecutors after pleading guilty to fraud. His testimony promises to be among the most powerful in the government case against Bankman-Fried, who has pleaded not guilty. Coming up, Perry Warjo, the Indonesian central bank governor, joins us here for an exclusive conversation. That's coming up shortly, and this is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Traders prepare for a U.S. payroll print forecast to show hiring slowed last month, while the Fed's Mary Daly says rates can hold steady if the labor market continues to cool. We're live from Granada, Spain, where EU leaders will be laying the ground for the bloc's strategic agenda. The Ukrainian President Volodymyr Zelensky urges them to stay united in the face of Russian aggression. Plus, Bloomberg has learned that Exxon is in talks to acquire the shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals this year. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Indonesia's foreign reserves have fallen by over $2 billion to a 10-month low. This comes as the central bank intervened to stabilize the rupiah and the government repaid external debt. Well, with us now is the Bank of Indonesia Governor Hisperi Wadijio. And thank you, Governor, for joining us for a robust conversation on how difficult it is to set monetary policy right now. How quickly can you cut interest rates?
Well, we have to hold our policy rates for a while, not because of Indonesian inflation, which is very low. We need to support good because of the global spillover, which is because uncertainty and the Fed fund rate increase and the pressure of very strong dollar. So we need to wait that.
But, Governor, what's a while? Is it the first half, the second half of next year? How difficult is it at this point to try and calibrate when the move down could come?
Well, in this very difficult, uncertain world, you know, Francine, I have the beyond. Our securities for the short-term liquidity, this actually creating liquidity, also building market mechanism in the domestic yield as well as domestic rupiah vis-a-vis dollar. This is actually adding even more efficient market.
But your biggest concern is that you're now going to import inflation, weaker rupiah, higher energy prices.
Yeah.
This is concerning.
This is actually our objective of stabilizing exchange rate. Not targeting the exchange rate, but minimizing the volatility of the exchange rate and their impact to the imported inflation. So what we addressing, for instance, is imported inflation. Because otherwise, if imported inflation high, inflation rising, then I have to address with interest rate. This is cutting the global spillover to not, going into the domestic problem.
But so, given all the uncertainty with the Fed, how much volatility are you still expecting from outside currencies, from some of these outside shocks that then spills over and makes it more problematic for Bank of Indonesia?
We have 137 billion US. It's more than enough to intervene. One. Second, we have also incoming inflows from this portfolio inflows. Our management of Bank Indonesia Rupiah and FX securities, as well as increasing FX deposit from natural resource. They're already increasing. We expect end of this year will be about 8 to 9 billion US from natural resource export. This is government regulation.
So, Governor, you seem to be suggesting that because you have that firepower, you'll probably have to intervene some more in rupiah.
If needed, yes. We will continue in the market for stabilizing exchange as well as managing our yield differential of the government vis-a-vis US Treasury, so that the portfolio inflow will be there, stabilizing our exchange rate. So this is the tactic of, in a different, X on the basket. We do intervention, we do also managing yield, and the target inflow of portfolio, stabilizing the exchange rate.
Governor, do you think that your next interest rate move is a cut or a hike?
Well, friends, we have inflation very low. Last month is 2.7. End of the year, 3%. Next year, 2.8%. Then, actually, the natural response, if we only consider domestic, then actually our policy rate need to be lower. But I cannot lower our policy rate because of the global spillover. So we have to be patient. We have to be patient on that aspect.
But again, in terms of sequencing, so do you need to see a Fed rate cut before you cut?
Well, depending on the investor preferences. What I'm seeing in the foreign investor is seeing the uncertainty. Whether November, the last cut, and the last increase of the Fed fund rate. Whether US Treasury will keep rising or declining. Whether dollar will be declining from 106 to 104, 101. If that's stabilizing, then foreign investor, okay, time to invest in Indonesia. Time to go to Indonesia because Indonesia is one of the best performer in emerging market. Whereas, if that happening, then rupiah will be strengthening, right? So this is the dynamic that we are seeing over the coming month, friends, and in this uncertain world, we have to be patient. The patience is very important, right?
Are you looking again to calibrate or reducing the RRR as a possible pivot point? Is that your first point to try and change monetary policy? Well,
we have a good practice in the bank, central bank, that we need to forecast 2 years down the road. Inflation, growth, exchange rate, what the likelihood of Fed fund rate, US Treasury, and so on. We calibrate that month by month, and then, of course, we will announce every board meeting. But from now on, we want to focus on stabilizing our exchange rate and holding our policy rate. Our inflation will be very low, coming down. Our economic growth will be much better. Indonesia continue the best economic performance.
Governor, a final question. How much volatility are you expecting from election season? And what can the central bank do to prepare for that?
For?
Elections.
Well, Indonesia is a big country, a very democratic country. We have been going into a number of peaceful, election. I'm not expecting that the election will adding volatility in our macroeconomic and financial stability.
Okay, Governor, thank you so much. It was a really great pleasure to host you here in the studio. That was Perry Waryo, the Bank of Indonesia governor. Now, coming up, Ukrainian President Volodymyr Zelensky is looking for concrete pledges from his European allies, while U.S. officials are trying hard to reassure their allies that the money is coming. We'll go live to Grenada for more on the EU summit next, and this is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the U.S.
Nobody covers business like Bloomberg. Context changes everything.
Now, EU leaders gather for a second day in Grenada, Spain, after the Ukrainian President Volodymyr Zelensky urged them to stay united in the face of Russian aggression. Meanwhile, the U.S. ambassador to NATO, Julian Smith, sought to reassure European allies, telling Bloomberg, quote, the U.S. is not going anywhere.
I think American leadership is here to stay. We've seen the United States take the important leadership role ever since Russia went into Ukraine. We obviously have a temporary situation right now with this continuing resolution that does not include increased support for Ukraine, but based on broad support across Congress for U.S. support for Ukraine, based on what President Biden said when he got on the phone with our allies and with President Zelensky in recent days, and based on what you see in terms of polling across the United States, we anticipate that American support for Ukraine will continue. Americans fundamentally understand what's at stake.
Now, for more on all of this, let's get straight to our European correspondent, Maria Tadeo. Maria, good morning. A diplomatic effort from the Ukrainian president. What did he actually achieve?
Yes, Francine, and as you played there, when we spoke to the NATO ambassador to the U.S., she asked and answered those questions about Zelensky, some of his concerns, and not just Ukraine, but really the European Union about whether or not the Biden doctrine is changing. And she said this is just a temporary situation, but nonetheless, this really permeated debate yesterday here in Spain. And to answer your question, President Zelensky was here. It was, so to speak, a diplomatic offensive. He was here for less than 24 hours, I should say. As far as we know, he traveled to Poland Poland, and now he is back in Ukraine. And he carried almost a twofold message. One is that both the U.S. and Europe made a promise to help Ukraine, and this is a moment of unity. Francine, just to let you in on an anecdote from yesterday, when the session was over, a small group of journalists, we were called into a room and spoke to President Zelensky, and one of the questions that was asked is, does he fear, however, this is the end of the Biden doctrine, weapons and money to Ukraine? He did say that is a dangerous prospect. He said that politics is dangerous. Some of the voices in the U.S. he described as being somewhat strange, but nonetheless also said that for Ukraine, there's not been an easy day ever since the war started. Now, the second point made by Zelensky is that the country will also need a logistical operation going into the winter. The concern for Ukraine is not just the counteroffensive and the change in the weather, but it's also potentially seeing a repeat of what happened last year. Remember when Russia attacked some of their strategic infrastructure, the country went into a blackout for a number of days. They say they want to avoid that, and for that, they will need more air defense fast so they can have it in place by December.
Yeah, I have to say, Maria, there's also quite a lot. I think there was an interview yesterday with the former European Commissioner, Mr. Juncker, talking about corruption in Ukraine, which we probably need to spend a bit more time on. But the focus turns also to European politics, and I don't know whether they focus a lot on AI or whether the European leaders now look at a possible Trump win and think of tariffs.
Yes, and Francine, I'm going to go slightly off script here because you made a very good point. Jean-Claude Juncker said enlargement for Ukraine, and that is the issue that will be debated today, is not possible because the country is corrupt at every level. I actually asked that question to Zelensky, and he told me that Mr. Juncker has not been to Ukraine a single day ever since the war started, and he also told me, anyway, he's an old man, I wish him health. So that was the response from Zelensky. In terms of today, again, enlargement on the agenda. Yesterday, we spoke with the head of the European Council. He manages this debate, and he says that by 2030, the European Union should be ready to take in new members. But that is nothing short of a revolution almost for the EU. Let's take a look.
The candidate countries, the applicants, they need to do their homework, and they know what we are expecting from them. We are expecting reforms, rule of law, independence of justice, fight against corruption. Why? Because the purpose of the enlargement is not to be bigger. This is not the main purpose. The purpose is to be more influential, more powerful, to protect and to defend the interests of our citizens. When I say 2030, this is ambitious, I know, but it's realistic.
And that was President Michel talking to Bloomberg yesterday. He says 2030 for the actual enlargement to happen. But when it comes to Ukraine specifically, the country says it wants to open accession talks this year, before the end of the year.
Maria, thanks so much. As always, I have to say that was quite a put down, actually saying, you know, he's an old man, I wish him well. We have to get you back on that to talk about some of the epic put downs that we've seen over the last couple of months. Maria Tadeo there in Granada, Spain, of course, following the EU leaders. Now, here in the UK, the Labour Party has won a by-election in Scotland on a large swing from the Scottish National Party. The victory boosts Labour leader Keir Starmer's argument that his opposition party is on track to win enough seats to win the next general election against the Prime Minister, Rishi Sunak. Well, Bloomberg's Ruth David now joins us. Ruth, I love it. It's only the big political things that get you on air. So I'm very happy anything big happens. And what a delight to have all of your insight and analysis. So how significant, first of all, is the result for Labour?
Well, if you're listening to Keir Starmer, it's seismic. I think a few things to keep in mind. One, this is the first major election, Ruth Glenn, that they've had since March, when a very popular leader, Nicola Sturgeon of the SNP, stepped down. And this, Scotland, you know, the seats have always alternated between SNP and Labour. Absolutely, this is a big comeback for Labour, but it's one seat in a special election, and they're putting a lot of weight on it. But if you look at what the bookies were saying and what the strategists were saying, if they hadn't won it, it would have been a huge headache for Keir Starmer, especially going into their annual conference over the weekend. So I think we have to put it into the context of what's happening in the broader scenario. Labour is kind of clawing back some of the gains in Scotland, where they're opposition to holding another referendum and going back to the European Union had undercut their wins, but the S&P is facing its own struggles, right?
Yeah, and this is, you're right. If they hadn't done it, that would have been a huge story, and it would have, put a lot of question marks surrounding labor. So what are we expecting from the party conference that starts on Sunday?
He's going to start it on a high note, absolutely, and lay out his strategy for winning the elections next year. Labour is still polling 20 points ahead of the Conservatives in the polls, so they have that kind of lead for them. But, the UK's election of first past the polls, the way that they gain victory in Parliament means that just because they're polling this much higher is not a certainty, and they still have a long way to go. I mean, some of the economic headwinds that are facing Rishi Sunak, and when we're talking about just how much room do you have to give away fiscal like tax benefits or to cut taxes or to do any of these things, the economy and the state of it is going to stay the same. So voters will be thinking very carefully, if we get Labour into power, what changes for us? And unless they can come up with a coherent plan of what really changes to make voters' lives better, I think that discontent is something that might colour both parties.
Ruth, thank you so much, as always, for your insight. Ruth David there, our London bureau chief, looking at the politics of the UK. Now, the US and China are said to be moving closer to setting up a meeting between President Joe Biden and Xi Jinping at next month's APEC summit in California. Now, sources say both countries have been scouting meeting sites in San Francisco. Well, Biden and Xi have not spoken since the G20 in Bali last year. Neither side has confirmed the meeting. Now, coming up, it's been a turbulent time for Sweden's biggest pension fund after losing its chairwoman and billions of dollars. So we look at the future for Alecta. That's next, and this is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Well, switching gears to European rates in the property sector, Sweden's biggest pension fund, Alecta, which manages 1.2 trillion kroner pension funds for a quarter of the Swedish population, is once again under the spotlight. Now, for more, let's get straight to Bloomberg's Love Lehman in Stockholm. Love, so what's causing the worries there, and how's the reaction been so far?
Yeah, as you said, it's Sweden's biggest pension fund, Alecta, with around $100 billion in assets under management. That is once again in the crosshairs after the debacle that we had earlier this spring with the U.S. niche banks, where it lost $2 billion. This time it has made a nearly $5 billion bet on a single real estate company called Heimstad and Bostad. And now there is a risk that that bet might go sour if it doesn't invest even more capital in it. And you have the wider media really scrutinizing this investment, the public as well, and they're questioning the grounds on which it was originally made.
So, Lovi, what's at stake here, actually? Are there any really contagion risks?
Could you repeat that, please?
What's at stake? Could we see contagion? Could it spread to other parts?
Yes, well, it is one of the biggest bond issuers among the European property companies. It has got around $10 billion worth of bonds issued. And some say there is a risk that if things go really bad for Heimstad and Bostad, it could lose its investment grade rating. And in that case, you might see more widespread contagion.
All right, interesting. Thank you so much, Lovi Lehman there in Stockholm. Now, Aviva, one of the biggest risers in Europe following the so-called uncooked mention in the Betterville report regarding potential takeover interests from the insurance company. Now, Bloomberg has reached out to Aviva representatives for comment. You can see Aviva gaining 9%. Now, Philips also suffered another setback as the U.S. drug regulator requested additional tests on its sleep apnea devices, warning that the company's analysis of the recalled products is inadequate. Up next, we have plenty more on the markets with our Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. The big story today is, of course, what's going on in the U.S. The U.S., left, right, and center with the jobs report, hopefully giving us a little bit of clues of what the Fed does or doesn't do next. This is Bloomberg. Happy Friday, everyone.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. ON's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
This is Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
It's all about bonds and jobs. We're counting down to the U.S. labor report that will help define the path ahead for the Fed. Mary Daly says the central bank may be able to avoid further hikes.
If we continue to see a cooling labor market and inflation heading back to our target, we can hold interest rates steady and let the effects of policy continue to work. Even if we hold rates steady exactly where they are today, policy is going to grow increasingly more restrictive as inflation and inflation expectations fall.
Bloomberg has learned that Exxon is in talks to acquire shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals this year. And it's been a tough 24 hours for Elon Musk. The SEC seeks to force the billionaire to testify on Twitter. And Tesla, it's cutting its prices again. Good morning. There's only one number that you've got to focus on. It is your jobs number, 170,000. Will it dip like ADP did? This is the state of the play in the bond market. We've got yields just rising ever so slightly. Mary Daly really being very clear. The market has done for us pretty much what we'd hoped for, that tightening from the yield market. Real yields are at a 20-year high. That will transmit at some description. Still, the houses out there, Bank of America say there's scope for 10-year yields to get to 5 1/8. What will Stephen Major, the Uber bond bull, make his call today? SocGen say the clearing rate for this bond market is 5, 5.25%, 5.5%. So let's see what the jobs number does to redefine risk. Do you want a real amount of risk going into this number? Probably not. Crude manages to go back in the green, down 9% on the week. Goldman says you don't want to pay too much attention to those gas numbers from yesterday. They say a soft landing remains on track. It is but a fleeting moment in the gasoline inventories. I thought we'd pop the dollar up there because ING, wrap it up beautifully for me, Danny. The dollar is expensive to sell here, and we have a feel that a wobbling bond market is the reason why you may just want to hold on to a few dollar longs. Danny, good morning.
Good morning, Manus. Well, we're holding on to everything right now and waiting until we get that jobs number. Very calm morning, not surprising again for an NFP payrolls day. S&P and NASDAQ futures, little change. European stocks, they have been surprisingly resilient amid the pummeling of this global bond market. But SocGen does say that 5% 10-year yields, that's where the market is expecting it to go. And should that happen, S&P will go to 4,000. S&P futures right now, 4,292. They still say buy the dips over the next next 6 months. Now, Bank of America points out, Manis, that it is the bond market that has priced in a recession. So the good news from them, this is from Michael Hartnett over there writing in their weekly Flow Show report, that should we actually get a recession show up in the data, because the bond market has already priced it in, that sovereign bonds, that treasuries, will be the best performing asset class of first half 2024.
And yet still, the money flows in, Danny, to the very short end of the money market funds. 64 billion went in last week. We have now got a record amount in these money market funds. And that caused us a lot of dislocation earlier in the year. 5.71 trillion has gone into money market funds, up from 5.64. So again, this is the kind of velocity that you've got in that race for cash. We've had various guests this week come on the show and say, I want to hide in cash. Danny.
And that thing is concerning, Manis, because these money market funds, the frothiness of them and the stark pull out of it during COVID is what forced the Fed to step in. Look, there's been plenty to worry about this week. So here's a quick recap of what some of our guests had to say about the dramatic moves in yields.
Everyone's concerned about catching a falling knife.
Bond volatility has been the bogeyman recently.
Typically with markets, things do overshoot. The 5% level is quite a scary level. We also need to focus on real yields.
It's really hard to know where we go from here. I have a feeling that people haven't actually woken up to the fact that for the first time in over 20 years, the yield on the bond market is actually higher than the yield on the equity market.
Something has to happen to make more people want to buy more bonds.
We're seeing a little bit of an oversold market here headed to 5%.
I think the fair value is somewhere closer to 5%. But don't assume that just because it's around 5%, we're there and so people should buy bonds. No.
A 5% 10-year treasury is a decent value. It's not great value.
Let's add another expert voice to that. Stephen Major, HSBC's Global Head of Fixed Income Research, joins us now. Stephen, I want to pick up where Bill Gross left off. He says decent but not great value. Is 5% on the 10-year yield just decent value to you?
You're talking to someone who's been very wrong, because I would have thought that was good value at 4, so yeah. 5 should be even better value. I think we've been wrong for mainly the right reasons. So we need to see these conditions changing that have caused this. So many of those guests pointed out the valuation piece. So real yields are above trend GDP, bonds versus equities, bonds look good, bonds versus cash are looking good, looking better at least. So the valuation piece is there, but the conditions that got us here, it's the deficits, therefore increased supply, with good times maintaining in the economy, no recession, and an inverted curve. Now, it seems to me that you could be getting to the point where maybe 2 out of 3 could be shifting. So if the data starts to tip away from good times towards bad times, then there's no lack of demand for the increased supply. So where we've been wrong is the fact that normally I don't think deficits matter, but investors have been asked to take these bonds when there's a big inversion and there's loads of them. So if you can remove the inversion and change the data backdrop, then the valuation piece will come in as well. So I think slowly the conditions are getting better.
Well, it takes a pretty big person to come on the show and say, listen, I've been wrong all the way up here, but laying out your stall. Good morning, Stephen, by the way. It's good to speak to you from New York.
Morning, Manis.
Term premium. I don't know the math. I'm not that intelligent, right? But you are. So term premium is turning higher, and this is part of the narrative for you. I know that. Is it rich enough for you to make a sort of a doubling down on your it is time to get long, or do you think you need to see more term premium before this market clears?
Yeah, so term premium is a symptom of something quite big happening. The last time we were writing about term premium was in 2014. That's after the taper tantrum, when it was really high. So that tells you something. So just to be clear, term premium's that additional bit of yield you get on top of what you would have had if you were just rolling bills. So it's the additional yield that you get from bonds as opposed to just holding bills through the life of that bond. Now, under most measures, it's risen by about 100 basis points, Manus, and that puts it back to levels of 15 to 20 years ago. So it's definitely more interesting. You are now being compensated to go into bonds, and I don't think you were so much before. So yes, the term premium is probably the signal of the capitulation. And if I go through these last 3 years where the yields have been rising, initially it was because the Fed and others were behind the curve, behind the inflation. Secondly, they doubled up and they went for 75 basis point hikes. You got a huge bear flattening. Right. And now the third stage has been the back end flipping, which is the term premium piece. So it could be that we're there, but someone like me, I have to say these things very quietly now, because you come on this show, you say something big, and you get hit immediately.
Unfortunately, Stephen, whether you say it quietly or loud, we will take notice.
Thank you.
Look, I think this element of humbleness is interesting. That the surprise that the deficit has mattered so much to the long end. So, to you, is that illogical? And if so, where is fair value right now?
I've made a thing, and most of the investors who follow our research will know that I say bonds are not potatoes. So you don't treat bonds like they're potatoes. They're sophisticated financial instruments. They can be repoed. They normally roll down the curve. The problem is right now they are like potatoes because they roll up the curve. So when you have an inverted curve, they're falling in price, and there's loads of them, and they're rotting. So they're just like potatoes. So you need to change the conditions that have pushed the bond market into the situation where it's being compared to vegetables. So that's slowly happening. I mean, I never really thought supply could ever matter. Saying that an increase in supply means a fall in price is kind of naive, because it presupposes the demand backdrop and all the other complexities. So it looks to me that with a recession, and here we come back to the data, with a recession, you won't have any lack of buyers at the right price.
So here's the thing then, Stephen, and we'll get a piece of that, an important piece of that data today on wages and on jobs. You used a very interesting word. You used the word capitulation in conjunction with term premium. So I stand here for 4 days in a row going, bond vigilantes, unanchored moves in the bond market. Now, it's not. This is not what I would call parabolic unanchored moves in a bond market, because you've lived through them, as have I. How would you describe this move? And if you're using the word capitulation, that suggests to me we're at some kind of an exhaustion point in this bond move.
Well, it seems to me it is. So it depends on what your reference point is, Manus. This time last year, we had a UK fiscal event, and I think we had a 100 basis point shift in 1 day on the UK gilts. I can go back, and I think 2014, we had a flash crash when yields went down. So they went in the other direction in a huge move. It looks to me that like this last 100 basis points or so is mainly explained by term premium, and it's come through the last 2 months. Maybe it's not of the same speed as the UK move from this time last year, but look, it's on top of a big move already.
Yeah.
So I use the word capitulation because I think there is evidence of throwing in the towel, and that's what I mean by capitulation.
Stephen, we have much more to cover with you. Stay right there. Stephen Major there of HSBC is going to stay with us. First, though, some top stories trending on the terminal this morning we want to make you aware of. Former U.S. President Donald Trump is endorsing Jim Jordan of Ohio to be the next U.S. House Speaker, saying the hardline Republican has his, quote, complete and total endorsement. Now, at the same time, the New York Times is reporting that Trump revealed nuclear submarine secrets to Australian billionaire Anthony Pratt at Mar-a-Lago soon after leaving office.
Well, the FTX co-founder Gary Wang has taken to the stand in the Sam Bankman-Fried trial, saying he and his former childhood friend and MIT roommate committed a multi-billion-dollar fraud. Wang is cooperating with the prosecutors after pleading guilty to fraud. Now, his testimony promises to be among probably the most powerful in the government case against Bankman-Fried, who's pleaded not guilty. Danny.
Now, Iranian human rights activist Narges Mohammadi was awarded the Nobel Peace Prize for 2023. Mohammadi was awarded the prize for her fight against the oppression of women in Iran and her fight to promote human rights for freedom and all.
Well, coming up later this hour, we'll have more on the big deal brewing at Exxon, the energy giant's biggest since 1999. as it seeks dominance in the US shale production. But up next, more from Stephen Major at HSBC. We'll get his view on the Bank of Japan and the global perspective that's taken hold of the bond markets, right here on Bloomberg.
Connection lost.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. On's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
This is your Friday edition of Bloomberg Brief with me, Menace Granny in New York, Danny Berger in London. We got there, Danny, but we didn't manage to break anything. The bond markets did that for us. Let's talk about JGBs and the Ueda shock and the Bernanke taper tantrum, which Mr. Stephen Major of HSBC, Global Head of Fixed Income Research, lived through and survived. Stephen, this is from Martin Malone over at Oral. He said, Manus, take a look at this. The taper tantrum, 2013, as you remember well. But the YCC, the dislocation of YCC, to what extent did the ripping off the Band-Aid of YCC have a more global impact, perhaps, than we are assuming? Good morning, Mr. Major.
So it's a good idea to compare the two. So in March 2013, Bernanke was already talking about it. There was a paper that mentioned term premium 15, 16 times. So no one was listening. It took until May for people to start to realize that they were serious about going from QE infinity to QE end. And then it got really moving, it got motoring through the second half of the calendar year. With this one, the first move from the BOJ was just before last Christmas. And we've had other iterative shifts since then. And actually, in the current guise, the YCC includes the number 100. So that there is a tolerance for JGB 10 years to get to 100. The 40-year was through 2% this morning, which I think someone picked up on Bloomberg. So everything says that we're on the way towards what is some measure of fair value. So Bank of Japan modeling has put it between 80 and 100. Mm-hmm. Right. How much of a surprise would it be if they ended YCC right now?
I mean, maybe not a surprise, because more folks see it coming. But if they do, what does that do to the picture that Manus just showed us?
Yeah. So let's look at the counterfactuals. If they had done this 2 years ago, when the US 2-year was 15 basis points, it would have been pretty explosive. But if the 2-year is 5%, 500 basis points, then obviously there's more scope for global fixed income to soak this up. So I don't think it's a huge surprise. Put it this way, if you were a strategist working inside the Bank of Japan, when are you actually going to do this exactly? Do you think that you can wait another year? I mean, wouldn't it be a crying shame if you went through a whole interest rate cycle and they missed the chance to get rid of the YCC and the negative rates? So it seems to me that they must be ready to go soon. And I think that the issue for them is the noise and the volatility. So it's trying to do it smoothly without creating big eruptions. But the idea that higher JGB yields means higher Treasury yields, I think that's one for in the past. I don't think it's going to matter so much now.
Okay, that's fine. But you do draw the comparison. You say the prevailing U.S. exceptionalism, as if outside events just don't matter. So you've put down your stake that the recession could come, the data could roll over. But you talk about a new normal of the U.S. economy was made 25 years ago under Greenspan, and that was questioned. You are worried about other events that could come to pass, aren't you? And what is the biggest event? So, contextualize it briefly.
Yeah. So thank you. You've seen it in our research. So it's easy to look at the cyclical and the local factors for the U.S. So that's the data and maybe regional banks. But globally, what's going on in China? What's going on in Europe? This divergence between the big blocks in the global economy, that does not go unnoticed. Now, is it through the FX or capital flows or through trade or some kind of contagion? I don't know, but it has to matter. And we look back through history and you see these great divergences, that they tend not to end well. So without knowing exactly how this plays out, it looks to me like it's another thing that we should consider. At the moment, the market's pricing U.S. exceptionalism, but you know, how far away can U.S. yields get from the big blocks in Asia and Europe?
But still, I look at Europe and I look at what yields have done over the past 2 weeks, and it's hard not to say this isn't fundamentals. This is the U.S. This is the U.S. bond market causing this sell-off. So what does that mean for Europe if the bond market is being bullied around?
So, and notice that European yields have followed the US, but Chinese yields haven't. So there's definitely an Asia-Europe-US disconnect here. So the last thing Europe needs is higher bond yields, because you would have thought that the data, if you just looked at the data, it was pointing more to recession risks in Europe than just about anywhere else. So look at the loan growth, for example, and some of the recent incoming. So this is the last thing that the ECB needs right now. And to me, it just kind of bakes in the cake the idea that we're at the peak in the cycle. Okay. And really, it now becomes a question of when the rates go down.
Let's get two last stakers in the ground from you. You know, you started the show by saying, "Look, I was wrong on the way up here," but you do like gilts, and you do like UK long-dated paper. Where can that get to in the medium term? Put your stake down for Christmas.
Well, yes, we shouldn't be too encumbered by what's happened. So we take a clean sheet of paper, you look at the long-dated real yields, and it's the UK and US that stands out. Yeah. And I think that hopefully we've learned our lesson. We've been wrong, but it's the entry point. I mean, how wrong can you be when you've got real yields that are so far above the trend GDP, and the valuations of bonds versus equities starting to be in your favour? So it's the long end of the UK and US that we like here.
All right, Stephen, looking forward to you joining us again shortly and being able to say you were right this time. Stephen Major of HSBC, always a humble gentleman joining on the show. All right, as we head to break, a quick check on these markets, much more calm, but it is jobs day, so that is not surprising. The long end, that's where the value is. UK 10-year yields, those just above 4.5%, 10 years 4.7%. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
Is
story.
there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Brief. I'm Danny Berger in London, alongside Manish Cranny in New York. The SEC is seeking to force Elon Musk to testify as it investigates the billionaire's purchases of Twitter shares ahead of his takeover of the social media platform. But Manish, that's not the only trouble Musk is facing. It's been a tough 24 hours for him.
Yeah, I mean, it's been a tough old 24 hours. We're also seeing more price cuts come through on Tesla, Danny. This is on the Model 3 and the Y. This is here in the US, and this was on the miss. If you remember last week, we did the miss on the quarterly sales, etc. And again, prices have been slashed. Model 3 comes down to $38,990, down from just over $40,240. So again, more price to come. And again, it's the battle for market share, isn't it?
It is. I mean, BYD, the cheaper Chinese-made electric vehicles, have really been nudging their way in. In other EV news, a really bad day for Rivian to a record drop, Manus. They announced plans to issue $1.5 billion in convertible bonds. One analyst from Evercore ISI saying, look, the numbers were what we expected. It just came too soon, and the market, I guess, hated it.
Yeah, I mean, there's a small bounce back there. The stock sank by 23% yesterday, and that's below the IPO price. I mean, I think they were just surprised that they came for a call of cash so soon. One next, right here on Bloomberg.
We're back
for another season of AI IRL.
My opinions sometimes elicit unfriendly responses from my peers, but let me try to explain my thought on it.
So to start, Twitter and X are two totally different companies in my head. Companies are driven by the culture of the people who are there. They're two totally different places.
Not to ask people about their bosses, but, you know, Mark Zuckerberg, how is it changing his priorities?
A lot of time and thought is invested into how you can innovate.
It turns out that, you know, the popular chatbots, ChatGPT, Bard, and others are so easily hackable to actually drive a different agenda from what is bounded as a response mechanism.
There's a tipping point here where the images have become so good that really smart people who are by design critical are falling for it. That was number one. But here's the other one that really scared me.
Do you think that there's potential to see kind of an AI Rust Belt of sorts?
My personal opinion is no. That might be somewhat contrary to what others are thinking.
Do you think that it can replicate the solace and comfort some people feel with religion?
What I have seen is that it really varies depending on how people think about the way that, you know, higher powers or the divine might move through the material world.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. It's all about bonds and jobs. We're counting down to the U.S. labor report that will help define the path ahead for the Fed. Mary Daly says the central bank may be able to avoid further hikes. Bloomberg has learned that Exxon is in talks to acquire shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals of this year. And it's been a tough 24 hours for Elon Musk. The SEC seeks to force the billionaire to testify on Twitter, and Tesla is cutting prices again. Calm in this equity market, but it is jobs day, so it's not unusual to see this morning. The handover from Asia was calm too, but of course China is offline. It will be interesting to see what happens Monday when those markets open back up from the Golden Week holiday. So we're higher across the board, be it S&P and NASDAQ futures. European stocks do even better, up 0.5%. But again, SocGen says that bond yields are going to 5%, and that when that happens, it's likely the S&P will go to 4,000. Manus, we also just had some breaking news just moments ago. European natural gas prices have jumped. They're now higher by about 5%. That's off the back of the news that Australia's unions there around the Chevron LNG sites have decided to resume their strike. They are going to resume industrial action. And as we learned earlier in the morning, that workers had accused Chevron of reneging on some of the commitments that were made last month, and that was to end a dispute that roiled global markets. It had really impacted, again, European natural gas markets. This pop-up right here is all we've seen. So not a huge move, at least for now, Manus, but something we're going to keep an eye on.
Well, we'll certainly bring that question on gas prices as a result of strikes, but also the weaponization of energy when we talk to the Austrian finance minister in just a moment. How prepared is Europe for another weaponization of energy? Across the asset board, yields this morning, they're nervous ahead of the only one figure that matters, which is the jobs report. 170,000 is what we're looking at. Yields pop just up. The question is, the message from the Fed, Mary Daly saying, look, the market has already tightened the extra hike that we need to do. We just caught up with Stephen Major. He said he's surprised how much deficits have mattered to the narrative within the bond market. He says term premium, which is at a 20-year high, is now something that the market will pay attention to. And he talked about capitulation in terms of a sense of exhaustion in this market. Crude is down by an eighth of 1%. We've dropped by 9% this week. Of course, we saw the drop in the gasoline consumption in the United States. Goldman Sachs say very clearly, stop looking at that. That's not really something. It's going to be fleeting. If anything, the soft landing for them still remains on track. Again, going back to what Stephen Major said, once this data turns, there's going to be buyers aplenty coming in to gorge on these bonds. Bloomberg Dollar Index, it's expensive to short. That's the message going into this jobs number. The dollar is expensive, according to ING, and we feel a wobbling bond support that view on the dollar. So that's the state of play on the markets. Danny.
Yeah, and again, I find this thing from Stephen Major really fascinating, Manus. The humbleness to admit, look, I am surprised, is what he told us, that the bond market was so obsessed with the deficit and so obsessed from supply. But we got to be honest, it's not just the bond market, it's also Fed officials. They've pointed to supply being an issue for higher yields too.
They have indeed. And the other dislocation, just as we go into this jobs day, is that money is gushing in to those money market funds. 5.71 trillion has gone in, 64 billion last week. So that flow of money has not ended, and there are repercussions. We have seen that before. How will that play out again? Danny?
It has repercussions in global markets. European yields are also moving higher. Now, all of this, the backdrop geopolitically for it, is EU leaders gathering for a second day in Spain. That's after Ukrainian President Vladimir Zelensky urged them to stay united in the face of Russian aggression. U.S. Ambassador to NATO Julianne Smith sought to reassure European allies, speaking to Bloomberg TV yesterday.
I think American leadership is here to stay. We've seen the United States take the important leadership role ever since Russia went into Ukraine. We obviously have a temporary situation right now with this continuing resolution that does not include increased support for Ukraine, but based on broad support across Congress for U.S. support for Ukraine, based on what President Biden said when he got on the phone with our allies and with President Zelensky in recent days, and based on what you see in terms of polling across the United States, we anticipate that American support for Ukraine will continue. Americans fundamentally understand what's at stake.
Let's now go to our European correspondent, Maria Tadeo, who's been on the ground in Granada. Maria, what's top of the agenda?
Well, Danny, there's a lot on the agenda today, but just to take a moment, of course, to reflect, as you say, on this diplomatic mission that President Zelensky was in yesterday. Really hectic 24 hours for the Ukrainian president. He got here in the morning, and as far as I know, he should be back in Ukraine now. And again, his message was that of unity. He repeated, this is a moment where the United States and Europe has to support Ukraine. Just to let you in on an anecdote, by the end of the session, a number of reporters, including myself, we were taken into a room. We spoke with President Zelensky, and we asked that question, however, do you fear the Biden doctrine money and weapons to Ukraine is coming to an end? This is a man who's obviously very aware that this is an election year in the United States. He says that is a dangerous prospect. He talked about some strange voices in U.S. politics, but he also said there's not been an easy day for Ukraine ever since the war started. That's on the diplomatic front. When it comes to the logistics of the war, the Ukrainian president said that, of course, the counteroffensive continues before the weather changes. And when it comes to the winter, he also said the country will need more air defense, because what they fear now is that we're going to get a repeat situation of what happened last winter. Remember, Russia hit their strategic infrastructure. The power went down. The electricity went down. For some days, the country went into blackout. President Zelensky says he wants to avoid that this winter.
Maria, thank you very much for that. That's Bloomberg's Maria Tadeo reporting from Granada, Spain. Now let's dig more into the picture of not just the geopolitics, but how that interacts with the economic picture facing Europe. Joining us now is Austrian Finance Minister Magnus Brunner. Magnus, thank you so much for joining us, Minister. Look, the global landscape in front of you at this moment. You have yields marching higher across the world, but in Europe specifically. You have China delivering less velocity than many had hoped it would. So Austria skirted a recession so far this year. Are you confident that it can continue to avoid one and that you will have a strong bounce back in 2024?
Well, I'm always confident, but not naive. That's my attitude. No, we're in difficult times, very challenging times, I would say, economically. We did quite well last year, having a growth of GDP of more than 5%, which is above the European average, above Germany. We always compare ourselves to Germany, have to.
Everyone has to.
Everyone has to, but especially Austria, of course. We were doing quite well, but of course now the times are different. And especially because of Germany also, because we are very much dependent on Germany. And sort of we're going into a recession in the third and fourth quarter of this year, but the expectations for next year are not that bad. We're expecting growth of more than 1% for next year, so I'm still quite optimistic.
Good morning, Minister. Good to see you. That optimism obviously depends on a great deal on the global stage. France is flatlining. Germany is the sick man of Europe. China is not growing. So what is it that's going to help you be confident that you return to growth in 2024? What is it that's going to drive that growth for you?
Well, especially how we present our budget. That's probably the most important thing. And we've got some things to do in the budget, definitely. Challenging times also for budgets in all over Europe, especially because I talked about the dependency of Germany. And we are all in the same boat in a way, because there are all these export-oriented countries like Germany, like Austria, like Sweden, Netherlands, and others are in difficult times. But what we have to do now in our budgets is to set the right scene for next year. We've got some priorities to do, like we're setting a lot of priorities on microelectronics, for instance, and to get the economy up again in the next year to come.
Well, you've long been a proponent of stricter fiscal rules for the entirety of the EU. We're in this situation now where you have both France and Italy looking like they're going to go above the 3% limit. What is at risk for Europe?
Yeah, we need new fiscal rules. We're just discussing these fiscal rules on a European level. Probably next week is sort of the next challenging time. But we have to, well, first of all, we have to get new rules. That's for sure by the end of the year. And I think we need some sustainable fiscal rules. I think that's a good attitude to have, in my opinion. Get more transparency also and more enforceable rules, because we had rules in the past which were not very enforceable.
Minister, what happens if we don't get that? What's at stake?
Well, we stick back to the old rules then. That's for sure. We definitely need rules, and if we don't get any new rules, we stick back to the old ones.
Well, the old rules, many people sort of fudged them in the first instance, Minister, time immemorial in Europe. I want to deal with a story at hand at the moment. We're tracking gas prices this morning. There's a strike in Australia. That's a constriction on supply. I want to get a broader perspective from you on Europe. Gas prices have plummeted since the Russian invasion of Ukraine. How prepared is Europe for a new weaponization of energy in this winter? Are you prepared? What are you doing? Are you on the front foot?
You're perfectly right. I think Russia and Putin uses gas and the energy altogether as a weapon against Europe, against the world, against Ukraine. And we have to prepare ourselves in the EU member states. And I think Austria is well prepared. Our gas storage capacities are very high compared to other European countries, and the gas storage capacities are full by more than 93%. So we are very well prepared for the winter which comes up. That's the good thing. And we have to work on more diversification of our gas system, because we were very much dependent on Russian gas, not only Russian gas, but rather the pipeline gas. And it was very good for our economy in the last years, of course, because it was cheaper gas than the LNG. Yep. And as Austria hasn't got an LNG, hasn't got a sea access, as you know, we are very much dependent on the pipeline gas. But we managed to diversify in the last months more to Norwegian gas, more to other gas systems, and that's the good perspective.
Now, one of the other issues facing Austria, and let's be honest, the world is facing this right now, is labor unrest. You have metal workers in Austria asking for a nearly 12% raise. Social workers, it's 15%. Can you realistically afford that? Can the country afford that?
Well, it's not in the politicians' hand to do these wages and the rises of wages. That's in Austria. It's the social partners who discuss that. But you're right. I mean, that of course fuels the inflation again, and the Austrian inflation is too high. We are now above the European average. We used to be below the European average last year. We're at 6.1% now. On the EU statistic level, we're at 5.8%, which is far too high, but there are different reasons for that. And one reason is of course, the very high wages, the rise of the wages. We are the highest in Europe, together with Belgium, and that fuels the inflation again.
Minister,
very brief big problem, yeah.
Very briefly, a response to, we've just caught up with Maria Zelensky, is speaking there about the concerns around the lack of funds or the break in the momentum of funds from the United States of America to Ukraine. How concerned is Austria? How concerned are European peers? Briefly, a response to the break in funding from the US.
Well, we are, of course, supporting Ukraine with all we can do. I just had a meeting with the EBRD this morning. We are supporting the EBRD, we're supporting the EIB as well. We're doing a lot as a small country, a small European country, to support the Ukraine. We have to stick to that as a European Union, but as a world altogether.
All right, Minister, thank you so much for your time. That is, of course, Magnus Brunner, the Austria Finance Minister. Now, coming up on the program, a big deal is brewing at Exxon. The acquisition that could be the energy giant's biggest since 1999 as it seeks dominance in U.S. shale producing. This is Bloomberg.
Names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Manus Granny in New York, Danny Berger in London. So Bloomberg has learned that Exxon, Danny, are in talks to acquire the shale-focused Pioneer Natural Resources. It's a deal that could be worth as much as $60 billion, potentially the largest acquisition this year. Joining us now is Will Kennedy, hot back from the Middle East, where he's been talking oil all week. So I want you to shift from pure commodity to pure deals. This is a beast of a deal. Does it make sense?
It's a very important deal, and I think if it goes through, could end up being seen as a landmark deal in the oil industry for several reasons. It will be Exxon's biggest deal in almost a quarter of a century since 1999, and of course be the defining move of Darren Wood's time as CEO. But what it would really do is change the landscape of the shale industry. Shale has been a boom that's been driven by the independent sector, companies like Pioneer, rather than the oil majors. They've got into it more latterly, but this would make Exxon by far the biggest beast in the Permian. They would have more than 1 million barrels a day of production from the Permian Basin alone, and they would be the dominant player in the US shale industry. So it really would change the landscape of the oil industry in the United States.
The backdrop for this is the conversation around $100 oil, and we were getting close there. We're above 90. Now we've slid back below $80. There's all this concern about demand, but Will, how warranted is it?
It's really interesting, and I was having a couple of conversations in the Middle East this week with people who sell oil, essentially, and they were saying that, they don't see the demand weakness. If you look at Saudi Arabia released its official selling prices. Those are the premiums they sell oil at over and above the market price, and they put them up. And that's a sign that they're confident that the oil market remains quite tight and they can place all the oil that they want. I think there's a feeling that the price action has been driven by the wider gyrations in macro markets, perhaps some profit taking, perhaps some very elevated prices last week on the front month. Well, the broader theme seems people seem fairly confident still.
Yeah, they do. I mean, those cuts are still there from the Saudis and the Russians. The Russians have just taken off their embargo. We didn't actually get through any more. You've had a great week in Abu Dhabi, great interviews with the Indian oil minister and beyond. I look forward to an upsum. Make sure you file that before you take the afternoon off. Will Kennedy there, tracking the oil movements. And we're going to stick with a quick check on the markets. It is jobs day. 170,000 is the number that is penciled, etched in your brain. S&P are slightly in the green. You got the dollar holding on to some gains. ING said it's expensive to short that Yankee. Good morning from New York.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
This is Bloomberg Brief. I'm Manus Crenny in New York, Danny Berger at London HQ. We're counting down to the main event of the day, the jobs report for September. It's due at 8:30 a.m. Eastern Time. Michael McKee got up early for us. He braved the early morning call ahead of surveillance. He is, of course, our international economics and policy correspondent. Good morning. Mike, good to see you. 170,000, it's the number that's in my brain, but take me beyond that number, or is that the critical number versus wages. How do you break it down?
This time I think it is the critical number, and the reason is the bond market and what's been happening in the bond market. It's almost less important what the numbers are today than how the bond market reacts to that, because as you heard Mary Daly on Bloomberg yesterday talking about how the bond market has functionally given us another quarter point of tightening. And so if we get a strong number today, you may see the market do the same thing and may start to get ahead of the Fed. Right now we're expecting 170,000, as you said, and we're expecting the unemployment rate to fall. Last month it went up 0.3, a big bump because so many people came into the labor force. That's not expected to repeat. And the wages number could be a surprise, but at this point, looks like it just sort of stays on the status quo.
Mike, I might be getting ahead of myself because I really don't care about September. I care about October. And I mean, that's because it is backwards looking by its very nature. That's what I'll stick with. But as we're entering a world of tighter financial conditions, will we look back on the report today and say, hey, perhaps that was peak, that was as good as it gets for this American job market?
Well, there's some people who think so. Bloomberg Economics is suggesting this is going to be the peak, but there are other analysts I've read who are saying we shouldn't see a whole lot of fall off at this point. We're getting into that time of year when companies are hiring extra for the holidays, and the question is, do they hire as many people as they normally do? If so, then maybe things don't drop off. If they think we're going to go into recession, they might drop off. The interesting thing today is that the market is leaning towards the idea of a stronger jobs report. The whisper number out there is 190,000, while the forecast is 170. So the market thinks maybe we're not quite there yet. We're still going to see some strength going forward. But you're right about September in the sense that September is not going to show any of the strike activity. The UAW and certainly the healthcare workers who went on strike won't show up until the October payrolls report in November, which comes after the next Fed meeting.
How tight is the wages market here? I mean, it's been something that has been constant in the reports in terms of the wages, the tightness, and organizations holding on to people and paying up. We've gone through a few strikes, as you say. Some of them have been resolved, some are still ongoing. That tightness in the wages market is what Larry Fink referred to with Danny. He talked about embedded structural inflation. So how important is the wages numbers today?
The wages number is important, but it has been coming down. So the Fed sees progress there. I mean, we were seeing people get 6, 7, 8, 9% increases to come back to work. Now that many of those positions have been filled, we're running at a 4.3% annual rate, and the Fed thinks that's just a little bit above the 3 to 3.5 that they consider sustainable. So at this point, it's beginning to look like progress is being made, and if that continues, then the Fed's going to be seeing, they hope, some progress on inflation. All we have is anecdotal data, but a lot of CEOs are telling Fed officials, who are telling me, that they don't have to pay as much to get people to come to work these days.
Do we just need Beyonce and Taylor Swift to go on another round of tours, Michael? Is that what's going to save us?
Well, yes, because then Danny can get tickets. You know, she's coming to London, and I'm sure you're standing in line for that. There is
for research purposes.
There's an argument about the big tours this past summer having added a lot to GDP. The numbers are kind of all over the place, and it depends on what you use as a multiplier, how many extra jobs are created by the jobs that are created. But there are rock tours and music tours every summer, so I'm not sure how many additional people got hired. Taylor Swift had 2 crews alternating, so maybe they added a couple hundred people to the payroll, but that's not going to make a big difference in the overall number of jobs. And besides, all those people would have started back in March when she started her tour.
Yeah, well, Taylor Swift's too busy with football and going to football at the moment, so maybe
don't go there. Don't go there, Manus.
Yeah, don't go there. Maybe that's a broader conversation. Mike, good to see you. And we look forward to you breaking those numbers on surveillance in just a moment from Danny and I. Look, you know, we didn't break anything, did we, Danny? But the bond market felt as if at one stage this week it asphyxiated at just over that 480 level on the 10s.
Yeah, I feel like Mary Daly in saying we didn't do the thing, the bond market did the thing for us. So
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to suicide.
Bloomberg. Context changes everything.
It feels like something's cracking.
I think it's problematic for the equity markets that you're having such convulsive moves in the bond markets.
These high yields are starting to spread into credit.
We are not calling for a recession. We think that call is premature.
The economy is not going to be able to handle these rates, but the Fed is going to be the last to admit that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market positive by 0.1% on the S&P 500, poised potentially for a fifth week of losses on the S&P 500. In the bond market, the epicenter of the pain over the last couple of months, the epicenter of the headlines worldwide. TK going into all of that. 170 the estimate on Wall Street.
170 the estimate on Wall Street. We're going to conflate here a lot of economic talk. Mike McKee with our leadership at 8:30 and John the markets as well. And my major message here at 6:00 on a Friday is the markets still matter. It's going to be fascinating to see the reactions towards the jobs report and at 8:31.
Drum roll, I want your reaction to this. Is bad news, good news a little bit later this morning. Do you want to respond to that? Good news, bad news, good news?
No, you know how much I hate that. I get confused by it, and I'm sorry, employment in America is a big deal. 170 is frankly a generous number, and the unemployment rate actually matters this time around.
The ADP report was a little bit of a test for that theory earlier on this week. And Lisa, for ADP, bad news was kind of good news.
Except that if you look at some of the revisions from a lot of different analysts, they've actually revised upwards their expectations for what we get for the jobs report. The whisper number is 187,000, similar to what we saw last month. There is this question, though. At what point is it just bad enough to be good news, but not too bad to be actually something that's economic Armageddon? And really what I'm feeling is everyone's waiting for something to break this cycle. And even though we have a little bit of common markets, there's still a 4.73% on a 10-year Treasury.
Amazing. My favorite note on a Friday comes from Michael Hartnett. It's called The Flow Show. Comes out every Friday morning. And in it, there's a question that he gets asked, and he provides an answer. Here's the question. What is no one asking you about? Here's the answer. 2024. How bizarre is that, Tom?
Yeah.
Here we are in Q4,
Yes.
and it's so weird that we just need to get through the fourth quarter. Hardly anyone's talking about 12 months out
This is
next year.
so important. I'm old enough to remember is Steve Whiting that we used to have a 3-year vision. People like Steve Whiting would sit there and go, we believe 2027, boom. And it's just come in and with the pandemic and with the shock of this bond market, with a lot of the media catching up with what you and I have been talking about price, the answer is the vision is maybe out to Halloween.
Let's talk about the vision forward. A couple of companies thinking about the vision forward. Pioneer, Exxon. Let's check out those pre-market. TK, Exxon very recently, all-time highs. I understand that Darren Woods is looking for something to buy, and that Scott Sheffield might have something to sell, because Mr. Sheffield is looking to retire, and Pioneer might well be on sale, according to the Wall Street Journal.
On a game theory basis, my headline here is they've only got one person to sell it to, ExxonMobil. One is number 2, one is number 4 in the Texan basin. People are expert at this. Amory Descend to join us here with some perspective as well. Frankly, Citigroup leads this morning with a terrific essay. We'll get to that later. John, let's look at scope and scale quickly here. Employees, Exxon and Pioneer, you know, it's maybe a 9-to-1 ratio, 10-to-1 ratio, and you've got free cash flow as well, about a 9-to-1 ratio.
Lisa, we're talking about potentially Exxon's biggest deal since '99, a $60 billion takeover.
Is this the beginning of reinvestment in fossil fuels, or is this the beginning of just basically consolidation as much as you can right now for cheap? Because there is this feeling that if you have big pockets, you'll be able to do things for a smaller company that the smaller company can't do on their own.
Exxon has big pockets. That stock is slightly negative in the pre-market. Pioneer a little bit higher. We'll talk about that a little bit later. Here's the price action if you are just joining us going into payrolls Friday. Futures are positive by 0.2%. Yields are a little bit higher by a couple of basis points, 473.81. The euro going absolutely nowhere. Bramo 105.57.
I'm wondering if we could really write the obituary on some of the bond market disruption if we do get some sort of upward surprise at 8:30 a.m. We do have the U.S. jobs report. The expectation is for 170,000 jobs, down from 187,000 last month. However, as some people are expecting, the whisper number is for it to be the same as last month with a declining unemployment rate. If we get that, what does the bond market look like? 9:45 a.m. I am so looking forward to this discussion. U.S. Acting Labor Secretary Julie Su joining our very own Jonathan Farrow on Bloomberg Television to talk about the labor market. Very curious to hear what she has to say about some of the labor movements and some of the action there.
He's going to grill.
I think it's going to be. It'll be a really fun interview to listen to.
This is going to be very polite, very relaxed. Tell us what you're seeing. What's happening? It's going to be that kind of conversation.
How do you feel?
How do you feel?
He comes on.
How do you feel?
The earnestness.
Isn't that what I usually ask policymakers how they feel, right?
Always.
How do you feel?
Know, what is your childhood like? Okay, 3 p.m. we have U.S. consumer credit for August coming out, and I think this is also pretty interesting at a time where you are seeing credit card debt rise at a significant and accelerating pace. How much of the consumer strength is being fueled by debt? Is this a warning sign or just a re-leveraging on pristine balance sheets post-pandemic?
Lisa, thank you. Steve Whiting with us this morning, I'm pleased to say, here in New York in the studio, Chief Investment Strategist, Chief Economist at Citi Global Wealth. Steve, good morning to you.
Good morning.
What are you and the team looking for at about 8:30 Eastern Time?
So look, I think 170 is not too high a reading. If you just take a look at what happened in the month of August, unadjusted employment again was, held back a little bit. You already said where these are trivial numbers if you really think about it, but we know them. We know that the number of strikers were down in September versus August. We know that claims were quite low. So if the reading is in line with that Bloomberg whisper number, it wouldn't really surprise me too much. And, in the big picture of things, the last 3 months, Chairman Powell pointed out at the FOMC, was 150,000. The prior year was 430,000 for the same 3 months. So if it's not slowing fast enough for everyone, if it's not collapsing so we know it can only get better, I'm sorry. It's in a very gradual slowdown.
Two-part story, the data, how the market responds to it. TK hates this stuff, but we have to talk about it. Is bad news good news today?
Well, look, I think that there's been just tremendous apprehension. There's signs of capitulation. The Bloomberg's measures of market liquidity, again, have weakened for the Treasury market. Shorts look to be at record highs, but whether or not we can come to grips and change that trend on an employment data point, I'd be guessing to say. But it'll be fascinating to see the actual results.
I want to get to the profit picture, which you're expert at in a moment, but I've got to ask you about the bond carnage we're seeing and folded into a piercing paragraph in your note. It's not the 1970s. Is it just simple? Is disinflation to the rescue?
Well, I think that you'll see measured disinflation in the CPI in the coming year, for sure, just like we saw it this year. I mean, we were at a peak of 9, we got to a low of 3, we're headed a little bit back up. But by the end of next year, particularly shelter measures are going to be much lower on the CPI readings. Now, whether or not this is satisfying everybody about the long-term inflation outlook is unclear. But yields here again, where you take a look at real yields at 2008 levels, another period we had some difficulty with liquidity. If you believe the economy is slowing, this is satisfying. I have to say that the long end of the Treasury market with an inverted yield curve, it's counting on the Fed cutting rates. And that's what's been embedded for a long period of time. Just the mere fact that you're not collapsing the economy, the Fed is not shutting us down very hard, that's going to be hard to maintain that inverted yield curve, and that's part of the pressure here.
Right.
So it's really, again, much more of a normal rate than it is either 1970s or 2020.
The heart of my analysis, which goes exactly to what you've done for years at Citigroup, is to analyze corporate profits within the broader economic algebraic function. Great. My theory is the corporations will adapt like they've done before. Do you agree with that?
I do, and it's been a tough period to adapt. I mean, if you look at this past year, the rate of employment growth has exceeded GDP growth by the most since 1974. You know, one of those really great years. You know, so it's been an unusual period where labor markets have outperformed the economy. But that edge that the labor markets have, despite, you know, all of the labor action, I think is receding. And the coming year, like jobless recoveries of the past, is going to see the labor market slow. I think output actually has a chance of gaining some steam, particularly over the next 2 years.
John mentioned Michael Hartnett over at Bank of America. He also said this: bonds should be the best performing asset class in the first half of 2024. This is partly predicated on the idea of something collapsing or being taken down, some accident, something happening in markets to cause some sort of downturn. Do you get on board with this?
You know, it's hard to find this area of collapse, and you know, by the process of elimination, we find that there's all sorts of things are already happening now that make it hard to really generate a collapse. And you know, again, why? If the inflation rate is coming down, if we happen to have a low unemployment rate, is that enough for us to force a collapse in the economy? I think the Fed could collapse the economy if it really wanted to. When I take a look at the massive delivery of multifamily apartments that are coming, about 1 million that are still ready for completion. You know, this is an issue. Do I see that as a larger issue than the larger geopolitical risks? No, I don't. So sector by sector, we go through this. Look at the ISM report, how the manufacturing sector has been contracting for a year. Trade across the world has been contracting for a year. Residential investment down over 20%. You know, is this just the beginning? I don't think so. I think we're going to be in another period very similar to the Fed's forecast, where the economy stays below trend, where it's absorbing, you know, these losses. And unfortunately, but it's not this clear as day V-shaped decline in recovery.
So what I'm hearing from you is bonds maybe not so good, because if we could stay at this level and nothing breaks, then it's not necessarily a given that yields go down. And on the other side, you could see some of the stalwarts, the tech names, do all right, muddy through because they're growing revenues, but the rest of the sectors are going to continue struggling.
It's always wonderful when you can just say one asset class will greatly outperform the other, you know, when the reality is that they're going to perform together to some extent. That if bond yields decline, there will be certain equities that do well, even depending on the reason that yields fall. But, you know, I think it's important to see that the bond market can still be a successful place to invest if you hold the maturity, if you hold bonds of 4 to 5 year maturities with 6% yields in the investment grade corporate market. I mean, this is going to be higher than the cash yield over that same period.
I know we can't do single names with you, but I've got to ask you about what's happening in the energy patch this morning. Exxon nearing its biggest deal since 1999 with Pioneer, based on reporting from the Journal and according to a person familiar with the matter that we've heard from. When you wake up and see a deal like that, potentially 60 billion US for American oil, what do you take away from that?
You know, I think OPEC deciding that it's going to decrease its market share and it's going to cut production more than the entirety of the rise that we have seen out of American oil producers, you know, again, is providing value, soft landing, all of this to every Western energy producer. And if you want to talk about alternatives or conventional, we're building redundancy in the energy market, and it's benefiting everyone. And it means, again, a relatively higher price, but it's going to benefit energy producers outside of OPEC that they've done this.
Is it a sector you like then?
I think it's a sector that we think is going to be firm, that's going to be solid, and it's usually one we worry about in slowdowns. This is a case where I'm not worried about energy. in a slowdown.
That's a big change.
Yes.
Walk us through that.
Well, the typical energy sector response to recession, and again, my view of recession is it's not quite that. It's a real slow patch. But the typical average recession, the last 4 times, the energy sector was unprofitable, right? About a 100% drop. And we're not talking about the special case of 2020 with negative oil futures and like, loss. So it was horrendous. But even all of these other downturns, you've seen oil plunge to the 30s, to the 20s, and you've seen unprofitable energy companies. And American producers have been cautious. They've been raising production very slowly and conservatively, and under those circumstances, where there are significant supply risks around the world, Russia its oil exports are 6% of global consumption.
Yeah.
These things and OPEC cutting, all of these things together, has really arrested the decline. The energy sector is not going to suffer the kind of losses and a slowdown that it has in the past.
Hey, Steve, it was great to catch up.
Thank you.
Steve Whiting of Citi on Payrolls Friday on the potential there for a big deal for U.S. energy. From New York City, much more still to come on a payrolls report. The estimate 170,000 in our survey here at Bloomberg. Coming up through the next hour, Priya Misra of JP Morgan Asset Management. Do not miss that conversation. From New York this morning, good morning.
So you're not selling the Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
On the David Rubenstein Show, peer-to-peer conversation.
We're seeing a lot of strength.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, today on Bloomberg Television and Radio.
The second area that we think is really attractive is energy. This is really, again, it was the darling last year. It is actually at a very, very important technical level right now. If you look at a variety of different things, whether it's XLE or other variables, we are sitting at some really key levels. So understanding what we look into earnings season for energy market is still that discipline from corporations they've really been forced to by shareholders. So energy is interesting.
Energy is very interesting this week, that's for sure. Eric Friedman, CIO at US Bank Asset Management. Crude, the underlying commodity, heading for the biggest weekly loss going all the way back to March. Speaking of deals, according to reports here at Bloomberg, the Wall Street Journal, Exxon in talks to acquire Pioneer Natural Resources potentially for $60 billion US dollars. More on that in just a moment. Let's turn to the price action. This payroll's Friday. The estimate at the moment, 170,000. Equities on the S&P 500, slightly positive by 0.3%. A little bit of a lift here. Yields high by a couple of basis points, 473.81. But what a turnaround in the oil market. All the way back down. TK to 82.53. Slightly positive this morning, very negative on the week.
It's going to be interesting to see. And the major thing about it, you're coming down from the 100 level, 90, whatever it was, down to the 80s here. It's not so much that we came down, but it was the speed of it. And a lot of the research I read, brings it right over to gasoline demand. And Ben Laidler with a brilliant note this morning saying, look, gasoline makes up 3% of the inflation pie. So I got the politics of it, which is OMG, gasoline's going up, crisis and all that, versus the reality that we're nowhere near hydrocarbon dependent like we were in my youth when my father was driving around with a VW Rabbit.
Producing close to 13 million barrels a day in this country.
Do we understand that we're Saudi Arabia? I mean,
I remember a program, Bloomberg Surveillance, maybe 10 years ago when you called us Saudi America.
I said that?
You
no,
said
I don't.
that.
I don't remember.
I remember that a long time ago.
Amrita said remembers a long time ago. She looks at the geology of the Permian Basin and is expert on it. We're not going to do securities analysis here. We'll save that for another conversation on this important $60 billion potential transaction. Amrita said of energy aspects as well. Amrita, the stereotype of America out from Lubbock past Midland to Odessa onto New Mexico is 1924. There's oil in them, there are hills, and we went out and find it. That's the stereotype, the movies, James Dean and all that. Forget about it. What's the new stereotype? Why does Exxon want to span more oil from Lubbock to New Mexico?
I mean, look, you can see that from U.S. shale production. As you guys were just talking about, production has been rising close to 13 million barrels per day today, and it is still projected to continue rising. I think what we have seen, however, the last decade was very much about quantity over quality, right? Every CEO was incentivized to grow production and not return money to shareholders. And that's changed dramatically. And what you are seeing today is very much like slower growth, consolidated growth, and we've seen an enormous amount of M&A activity. Companies want to take over adjacent acreage, and they're getting more efficient. The number of M&A deals, we put out this piece a few months ago identifying 80 companies that could be taken over. 15 of that's already happened. And one of the very interesting things, Tom, you're seeing that is if, say, a company acquires another company, they are not continuing to run those rigs. 1+1 rigs is basically now becoming 1.2. They are getting rid of the poor rigs, and that's one of the big reasons why U.S. production growth has slowed.
We'll talk about the synergy memo starting to come out. Our Citigroup with a lead memo this morning. We'll do that later. Amrita Sen, I look at this and and of course we hearken back to Occidental taking out ginormous and wonderful Anadarko. Okay, fine. Are we consolidating the industry into a duopoly, a triopoly? Are we taking the independents out?
No, the independents are still there, but what we are taking out are tons and tons of the mom and pop shops, effectively, very, very tiny producers, private equity owned assets as well. What you are going to have is a much more efficient shale patch that actually produces good quality and at a cost where shareholders are happy. Like I was saying, last 10 years, they just grew production and nobody returned any money to anybody, which is fine in a zero interest rate environment, but that's not fine when interest rates are 5.5% or 6%, depending on which part of the curve you're on.
Amrita, how much is this deal also fueled by this idea that people are realizing that fossil fuels aren't going away so quickly, and that, if anything, they're going to be needed at all times, even during the transition to different types of energy?
I mean, I hope that is the realization. I just got back from Abu Dhabi this morning. I was there for ADIPEC, and I think in the region, it's very much the main focus, saying that, look, yes, we need to decarbonize, and something we've talked about, right, on this show, that let's talk about decarbonizing hydrocarbons. Let's not talk about not having fossil fuels at all, because if economic growth continues, population growth continues, what will happen is energy demand will grow. Those are like the basic truths. And if energy demand is going to grow, we're going to need all forms of energy, because we're not even investing investing enough in renewables, let alone in fossil fuels, to meet current energy demand, right? And that's the realization, hopefully, that's sinking in the West as well. The East gets it. It's much more for America and Europe to come around to that.
Meanwhile, we are looking at oil prices that have been on a wild ride. We saw them climbing. We were talking about $100 a barrel, and suddenly we saw the biggest decline this week, going back to March. Do you view this as too far, too fast, the way that Barclays does, or do you see this as something fundamental, especially in light of what we're seeing in copper and other commodities tracking this type of decline?
No, I don't think this is fundamentals. It's really been positioning driven. Open interest in options markets have been very high. The macro backdrop, you know, you've had treasuries rise consistently for a while now. Oil had decoupled, but it's definitely come back under kind of the macro scrutiny. Purely on a fundamental basis, look at the backwardation. Look at the front month versus the second and third month. That is extremely steep still, whether it be WTI, whether it be Brent, whether it be Dubai. It's telling you that the physical fundamentals are absolutely fine. You get flush outs like this, and you know, you don't get $5, $10 moves on fundamentals. That tends to be positioning or geopolitical driven, right? We'll get through this, and once we rebase, we will continue to move back higher again. But you'll always get, like, we'll never go up in a straight line. You know, when I was in the studio with you guys, I was saying that as well, right? You'll get some consolidation and volatility, and then we'll go up again.
And really quickly here, going back to Adam Szymanski and Paul Sankey at Deutsche Bank a million years ago, there's the Amarita Sense spreadsheet, Excel spreadsheet of demand. Which is the single line item of demand flexibility or movement that matters into November of this year? Which geography, which kind of oil signals to you where demand's heading?
I would say right now it's going to be the US, because that's where all the macro worries are. That are we slowing down significantly? Is it a collapse? I completely don't buy the gasoline demand print that came out of the EIA this week, but that's what we'd be focusing on the US gasoline, US diesel story. The rest of the world's okay. We know where it's headed. It's the US where the uncertainty is.
For people who just caught that line, Amrita, what do you mean you don't buy it?
I don't buy it because you don't get that kind. Okay, very simply, you can look at how much ethanol is being used in gasoline. You can back out gasoline demand from the ethanol usage. That still says it's close to 10 million barrels per day. The weekly EIA numbers are all over the place. They've never been too reliable, and off late, definitely not reliable. So I wouldn't pay too much attention to
Friday morning inorganic chemistry with Amrita Sen.
Amrita, appreciate it. Just quickly, I've got about 30 seconds. Triple-digit crude by Halloween. What's the call now?
I'm going to stick. It's a better call now that we're at 85 rather than when it was at 95. So I have to stick to that.
Okay. We'll speak to you around Halloween. Amrita, thank you.
She's getting
Amrita
spicy
Sen
here.
of Energy Aspects. Appreciate it. Well, a couple of weeks ago, it was triple digits by Halloween. Apparently, it's still triple digits by Halloween.
Mark Keller, the giant of A.G. Edwards' cautious conservative investment, once told me that the guesstimates and forecasts of American nat gas were a direct correlation with the temperature of the subway stop on Wall Street.
I remember hearing that. Coming up on the program, one of the greatest lines I think we've heard over the last couple of months, really poignant, really fundamental to the conversation we're having. Sarah House of Wells Fargo on the last mile of the inflation effort, that conversation coming up on this Payrolls Friday. Your estimate, 170K. Your payrolls report a couple of hours away. From New York, this is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. On's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
2 hours away from the payrolls report, here's the price action this Friday morning. Good morning to you on the S&P, on the Nasdaq, the Russell. Small caps firmer, higher by 0.5% on the Russell. On the S&P 500, up around about 1/3%, poised potentially for a fifth week of losses. Let's see if we can turn that around with the jobs report a little bit later. On the Nasdaq, we're firmer here by 1/3%. In the bond market, 5 consecutive weeks of yields higher on a 10-year maturity, up another 2 basis points this morning to 4.74. It's quite a turnaround in this bond market, isn't it? Breached 5% briefly earlier on the week, back down to about 4.90 on a 30-year. 4.91, up 2 basis points. The 2-year holding on to that 5 handle, 5.04%. Yields high here by a couple of basis points. Let's turn to foreign exchange. Keep an eye on this one. The euro against the dollar. The euro is negative on the week, just slightly, by about 0.1%. It's up on the session, just slightly, up by about 0.1% against the dollar. So here we are at 105.60, facing the real potential of 12 consecutive weeks of euro weakness, Bramo, against the US dollar. That is a record weekly losing streak already. We could well add to it later.
And that raises a question, what will it take for the euro to rally, given the fact that that region is really facing so many more difficult sort of recipes than the US? And we've seen the strength. Today's jobs number, if it comes out strong, what does that do to the euro?
Well, that's
the next step. Bond market after what we've seen already this week, TK.
What's so important here, folks, and this goes to the correlations across equities, bonds, currencies, commodities, is, you know, whether you're going up on the vector or down, we're out on the edge of the range. And it's I don't see research being written of the what if Lisa alludes to, what if we expand beyond to euro 102, to yen 151, bring it over to all the other elements as well. We're at that range point as we go into this jobs report.
Already had a little look at 104 in the last couple of weeks, back to about 105.60. Under surveillance this morning, the US jobs report coming out in about 2 hours' time. The median estimate in our survey calling for a 170K print with a range of calls from Wall Street's biggest banks. Andrew Hoddenhorst over at Citi looking for 240. Our next guest, who we'll speak to in just a moment, Sarah House of Wells Fargo, looking for 150. Look out for that one a little bit later. Exxon nearing a takeover of Pioneer in what could be the company's biggest acquisition since merging with Mobil in 1999. The deal could be worth as much as $60 billion and may be finalized in the coming days, according to the Wall Street Journal. Lisa, you put it all together, the combination, Pioneer and Exxon, we could be talking about the biggest oil producer with an output of about 1.2 million barrels a day, comparable with some OPEC plus nations, which is just absolutely phenomenal.
From a policy perspective, does the U.S. administration like this? I mean, you have to wonder, on one hand, there's a whole antitrust push, especially by this administration. On the other hand, if you can truly compete with Saudi Arabia at a time where oil prices, gasoline prices are a key component of, you know, the election and of consumer prices and how people feel, and you could potentially lower prices and make it more efficient, well, isn't that kind of a welcome thing?
That's what Citi's talking about this morning, TK. I know you've read that note, the prospect of economies of scale in a place where you might need it.
I don't want to go into it now. We'll do it later in the show. We got Sarah House coming up. But the bottom line here, folks, is the pros are moving the numbers. numbers are around